and welcome to today's morning market on close. My name's Will from The Officials, taking you through today's Singapore window. I mean, looking at Brent flat price, there's not much excitement out there, folks. It's really range bound. We have started to establish a little bit of a down channel if we draw the tops here on the chart. But we're starting to test that upper support, that upper resistance, actually. So perhaps we break higher. Who knows? But it's certainly starting to seem, it seems a little bit heavy to me. And that's true if we look at Brent spreads as well. For a while, we had a pretty strong rally in Brent spreads, up to 70 cents a barrel. But that seems to have turned over a little bit. And we're now kind of testing that 55 cents a barrel support there. And it looks like that could go lower. And I mean, if we're looking at the kind of the east-west as well, so Brent Dubai, it's pretty range bound. It's especially in the boxes. If we check out the box here, on a relative basis, structures, they don't want to move that much. But what has been more interesting is news in Asia over the weekend, over last night actually. We got the import quotas for Chinese independent refineries. That's the first batch for 2026. And they're at least 7.4 million metric tons. That's up over 1.4, well, around 1.4 million metric tons compared to the same time last year. And that will lend itself, that will lend some support for structures in Dubai. So if we pull up the Dubai physical premium chart, we see we kind of bottomed out at that kind of 50 cents a barrel level there. And now we're trading above 80 cents a barrel this morning. Like we said, the import quotas will lend support to Dubai structures, but really it's the same players in the window. The Chinese are still set on the sell side, and Trafi and TOTS are still leading the buy side. It's towards the end of the month now, so we don't anticipate much to change, but stay tuned for the new window next month. Thanks.
Well, hello and welcome to a Budget Day special here on Flux News. I'm Lisa Aziz. Coming up in the next 30 minutes, the Chancellor unveils her changes to tax, savings, pensions, benefits and plans to boost the UK economy.
I said there would be no return to austerity, and I meant it. This budget will maintain investment in our economy and in our National Health Service. I said I would cut the cost of living, and I meant it. This budget will bring down inflation and provide immediate relief for families.
But taxes for electric vehicle owners are now in sight, while energy bills are set to fall and AI investment set to grow.
Wales will be the host for 2 AI growth zones, creating more than 8,000 jobs, supported by a £10 million investment in the semiconductors critical for that industry.
And here's how the Tory leader reacted to it all.
Last year, she put up taxes by £40 billion, the biggest tax raid in British history. She promised that she wouldn't be back for more. She swore it was a one-off. She told everyone that from now on, it would be stability and she would pay for everything with growth. Today, she has broken every single one of those promises.
Plus, we get reaction from our own trading gurus across the world to the statement.
So this is more about where the world is going. And the world is going with increasing taxation. The UK has increased taxation by about £30 billion for the next global cycle, annual cycle.
Well, it was certainly a packed hour and a bit statement delivered by Rachel Reeves in a really noisy chamber this lunchtime, and certainly not helped at all by the Office for Budget Responsibility accidentally revealing the key measures some 40 minutes in advance. Extraordinary and potentially criminal, according to the Conservatives. Also in it, though, moves on the so-called mansion tax, the child benefit cap and fuel duty. Well, let's get some live reaction now. Vicky Price is a leading economist. She is Chief Economic Advisor at the Centre for Economics and Business Research at the British Chambers of Commerce. She's on their Economic Advisory Council. She's also visiting professor at Birmingham City Uni and King's College London. Vicky, really good to have you with us this afternoon. What did you make of the long-awaited, very late in the year, much leaked, much mooted budget?
Well, the interesting thing is, of course, that we saw it all because it came out an hour earlier, accidentally, by the OBR. But the interesting thing about it is that Rachel Reeves obviously seemed to think that with making lots of little changes, adding a bit of tax there, taking away some of the allowances for people taking salary sacrifices and making pension contributions that way, reducing that, adding a mansion tax at some point as well, and adding some extra costs to people who get income from either savings or property. She could get to the figure that she wanted to ensure the markets that she had enough headroom. And actually, if you look at it all, there are quite a lot of tax increases that have been assumed to happen between now and the end of Parliament. But the most important one is the freezing of the allowances that we already are experiencing, which are going to be extended for another 3 years. And that's what's given her a solid extra bit of income that she needs. But for me, it would have been so much simpler, if she had gone ahead with what she had hinted before, which is increasing income tax by 2p in the pound all across the board of the different tax bands, which would have raised quite easily 25 billion. And she wouldn't have needed to have gone through all this because, frankly, we don't know whether some of these assumptions that are made about how much is going to be collected that way will materialize. People change behaviors. If you're not going to be having some of those tax changes happen for another couple of years, in most cases, then you've got the problem of perhaps those revenues not appearing in the end and therefore needing to go back again and need to increase taxes for another session.
Absolutely, Vicky. As UK businesses then now digest the statement, digest the budget and what it means for them going forward, I'm thinking specifically next year, 2026, how would you sum up their options? Do you think that the Chancellor's decisions may end up actually, sending many to the wall, that they will still be thinking twice about hiring staff, growing the business, putting in extra investment?
Well, indeed, because of course it's not just the tax increases which are an issue. Up to a point, yes, because of course the national insurance contributions decision of last year has not been reversed, and that's had an effect already in terms of hiring decisions and investment decisions, and we've seen the economy flatlining over the last few months. But also, of course, the change in the taxation of salary sacrifices for pension contributions is going to cost businesses something like £4.7 billion extra once it's implemented, so a year. So that's a big issue for them. But in addition, you have announced with the budget, although we already knew it a little while before, the increase in minimum wage and living wage, which is going to be affecting loads of businesses, particularly in the hospitality and retail sector. And we know that that will mean either having AI taking over various jobs or having less hiring happen in the future, or closing down, as we've seen with pubs and other outlets over the last year or so.
Just thinking too, Vicky, internationally, how do you think other countries will view this budget and what it can do to grow the UK economy? Or are many in the EU and beyond, they're in exactly the same boat as us? It's pretty grim all round.
This is absolutely true. If you look particularly at the debt to GDP ratio of most countries in Europe, with the exception, of course, of Germany, what you find is that they have a higher debt than we do. The interesting thing, though, for me is that, yes, they're all trying to reduce their deficits because everyone accumulated a huge amount of debt during COVID. And also, of course, they had to respond to the shock of the oil price increases that happened with the war in Ukraine. So you had all that to deal with. But at the same time, the interesting thing for them is that they pay less in terms of the interest on their debt than we do. So even though they may have higher debt to GDP ratio, and that is the case, for example, in places like Italy, which has a yield that it pays on its 10-year gilt or bond, euro, of course, in euros, less, at least a whole percentage point less than we do. So there is something about the markets here not having necessarily believed that the fiscal rules could be met. But on the other hand, I think the positive thing here that we've seen in the budget is various measures to lower inflation and lower inflation expectations. And if that indeed proves to be the case and convinces the Bank of England that indeed inflation is going to be better looking ahead, and the OBR, the Office of Budget Responsibility, has already revised their own forecast for inflation, then we might see interest rates coming down a bit faster. And that will make up for the fact that people will be paying more tax. Working people will be paying more tax. People with savings will be paying more tax. People who also get income through property will be paying more tax. But hopefully lower interest rates will do something to offset at least part of it.
Just finally then, Vicky, and it's been so good to have you with us this afternoon. Tracking back, though, do you think it was fair to all of us, but particularly businesses, and you mentioned there the financial markets, that so much about this statement was indeed pre-floated, pitch-rolled and leaked?
Well, we have seen already comments suggesting that all that has meant a lot of uncertainty, and businesses were just waiting to see what the budget would contain, because, of course, things were floated and then taken away. So businesses were waiting for more confirmation what was going to happen. And if you look at what's been happening over the last few months, we've seen, hardly any growth in the economy. And I think it hasn't been a good process.
Vicky Price, thank you. Well, let's get some more reaction now from the markets and trading floors. James Brodie is our very own Head of Learning and Development, and he's a former trader as well. James, good to see you on this very, very busy day. For you then, what were the key takeaways? Certainly I'm thinking around promoting UK growth prospects and boosting business sentiment. Did the Chancellor go far enough?
Well, thank you, Lisa. Firstly, I think the market feared a lot worse. So there's actually a sigh of relief. We can see that from how the markets reacted. But certainly as well, the focus was much more on the consumer rather than business this time round. 920,000 people have moved into higher tax brackets as well, which creates quite a fiscal drag. Taxation's high means consumption investment will be lower. So we're starting to see that, and we see it actually with the forecasts going forward. Inflation's forecast higher and GDP projections are now lower. averaging 1.5% through to 2030, previously at 1.8. So the markets reacted, though, actually quite favourably. The real concern was really debt sustainability, and that's been alleviated with the budget coming out. So now the market's kind of relieved. The budget's better than was expected, and now the market's focusing on, well, what will this mean if growth is expected to weaken, especially as we've seen unemployment rise from, where was it, a year ago, 4.1%, now it's 5%, so that's certainly moving the wrong way.
Yeah, we've seen so much data come out just in the past few weeks, haven't we? Right now then, how are the financial markets actually reacting, say, along with gilts and currencies?
Well, if we look at the gilts, first of all, if we bring up the chart of that, really the 10-year yield, you can see it's actually gone largely sideways, basically for the whole year. And you can see right at the end here, the blue candle, the market's actually, the yields are down on the 10-year yield, 9 basis points on the day. So that's quite a lot of relief. The market's ready to buy UK gilts again. If you remember back to Liz Truss, the market was selling aggressively, yields were going aggressively higher. Well, you can see the market yields are coming back down, and actually now we're at 4.42%, 4.42. The key support's really about 3.37, so we're actually quite close to yields actually breaking aggressively lower, which would mean more buying's coming in. So that's two things. Firstly, it means international investors and investors are willing to buy our bonds again. But secondly, a bit of concern, growth is slowing and the central banks might need to cut rates again. If we look at what's priced in the OAS, we've got pretty much a full cut price, 23 basis points priced the Bank of England to cut on the 18th of December. And the market's now pricing 66 points of cuts. So nearly 3 cuts over the next 12 months. That was at 62 this morning. And here, if we look at the second chart, so this is the same, the 10-year gilt, but just pushed right out back to 2022. You can see the Liz Truss moment here in yellow.
And what a moment it was.
Absolutely. And you can see why the market really panicked there. It's because of the speed that yields went higher. Yields went up from 1.7% to 4.7% in 2 months. And that's why the huge concerns grew. We haven't really got that at the moment. And you can see actually now yields are starting to break lower. So you can see the key support, 4.37. This support line coming here, 4.30. They're coming in at the same point. If that breaks, then we're going to start to see more buying of bonds again. It means the concerns around the economy slowing. And actually, we've got a very similar level in the US, and we've got similar situation in the US, unemployment creeping higher. I think we're going to need more cuts from the central banks. But really now, as I say, the market's relieved with the budget, debt sustainability. The focus is now back on the economy. And if we bring up one final chart, here we have, this is the British pound cable. So the pound against the US dollar, you can see we had this period from January through till really July, where the pound was surging higher, all that dollar weakness that was being discussed in the markets. Well, now actually dollar's strengthened, the pound's weakened, but as you can see today, the pound looks like it's starting to break back up. Key level here, the previous low, 132.20. But again, it looks like the pound's looking to break higher against the US dollar. Again, that's a relief trade. The market's relieved with what's come out and move on to the next economic data.
Just update us too on the situation in the States, because we've spoken in recent days, haven't we, about a Fed rate cut really is due on the 10th of December.
Yeah, that's now 90% priced. The market's fully expecting that to happen. We've seen equities surge over the last couple of days, despite all the fear we've had in the market, especially around AI, Oracle. The S&P's 2% off the all-time highs. I think it's going to struggle to break all-time highs, but again, going into year-end on the 24th of December through to year-end, it's the Christmas, we see the Christmas rally, the Santa Claus rally, as they call it in the US. So the market's fully expecting a cut and equities are happy.
And Thanksgiving, of course, as well. And we saw that huge leap in the Dow Jones just yesterday.
Absolutely. Equities are rallying on this, seeing this as good news. Also, talk of the new Fed president's going to be much more dovish, of course. Yeah. Good for equities. Good news for now. But my concern with equities is volatility is picking up and certainly risks around the Nvidias, those stocks that we've got highly leveraged positions from retail in there. And yeah, Nvidia right now is falling compared to Google. So there's been a lot of discussion about the new Google chips that are coming out.
So interesting, that movement. James, thank you very much indeed. Well, still to come on our Flux News budget special this Wednesday afternoon, the view from our Onyx Capital trading floors around the world to the Chancellor's statement. Well, the main issue, or perhaps just plain annoyance for many in regards to this budget statement, surely has to be that so much of it was floated and leaked already, about everything from various tax hikes to even scrapping stamp duty. But now that it is officially out there and announced, let's get further market reaction live now with Onyx's own legendary market commentator, Jorge Montepeke. So, Jorge, what's the view then from Dubai?
So why are we talking about the UK budget here from Dubai? Well, you never know if there is a global impact to a small economy like the UK impacting global oil demand. Of course, there isn't. The UK economy is too small to affect anything on a global basis, but it's a good idea to keep an eye. So what has the government done? Well, what you would expect across Europe. So this is more about where the world is going. And the world is going with increasing taxation. The UK has increased taxation by about 30 billion pounds for the next global cycle, annual cycle. But this is happening everywhere. So we expect the governments to consume more and more of the money that the employees and workers are getting. And that means a misallocation of resources going elsewhere. And that means that the economies are going to grow a little bit slower than they were forecasted over time. This means that the demand for commodities is not going to be as substantial as we thought. This is going to be the same thing whether it's France, Germany, the US, Japan, or even China. The UK budget is now going to consume about almost 39% of the total economy going into taxes to the governments. But I think in general, you can say a third of your hard-earned money is getting eaten away. And this means a misallocation of resources. For economies here in the Middle East, that means that the prospects of seeing oil at $80, $100, it starts to look a little bit further away. So I think if we're going to talk about oil, it's better to focus on what is happening between the US and Russia. And there's no deal. And there won't be a deal this week. There won't be a deal next week. The Russians are not giving up on their objectives, which is to take more land from Ukraine. And the Europeans are not giving up on their objectives, which is to drive Russia back to where they were 3 years ago. So this means no deal at all. That is bullish for the markets, but the direction of the global economies is soft, and that is bearish to the market. So we're in the low 60s. Where will we be next week? Probably again in the low 60s.
Thanks, Jorge. And what about how this very late in the year UK budget is likely to impact Asian markets? What were they looking for in it to calm jitters and promote growth in the UK and international investment? Well, let's find out and join colleague Martha Dowding in our Singapore office.
From an Asian financial market perspective, the UK budget didn't spark much response across the region. While we did see some quick moves in sterling and UK gilts, the overall effect on Asian stocks and markets remains quite limited. What many investors in Asia are keeping an eye on is the UK government's long-term fiscal plan, specifically whether the UK can show credible fiscal discipline and maintain a stable investment climate. There's growing concern that the UK's financial health might be worsening, which could make the UK less appealing and even less attractive option for long-term investments from Asian investors. Around 25 to 30% of gilt stock is held by non-residents, higher than most advanced economies, highlighting the influence of foreign investors like Asian reserve managers and pension funds on UK debt prices. Japanese investors alone hold about $56 billion in sterling debt and £78 billion in UK direct investments. Major Asian institutions such as Korea's National Pension Service, Singapore's GIC and Temasek have also invested billions in UK real estate, infrastructure and corporate assets over the past decade. For these investors, this budget was less about eye-catching giveaways and more about these three things. Number one, a believable path to stabilise the debt ratio at today's high yield levels without further bond market scares. Secondly, a predictable rules-based approach to tax and regulation that reduces headline risk around existing UK positions. And lastly, a concrete supply-side reforms in planning, infrastructure, skills and energy that can raise potential growth and justify keeping or increasing long-term allocations to the UK.
Thank you, Martha. Let's bring things right back home now to the Onyx Capital Oil and Derivatives trading floor here in London. Manny Newman is head of desk. So, Manny, what's sentiment like over there then on the floor just now? Buoyant, gloomy, moved perhaps by there is a prospect of a relaxation on new oil and gas licences in the North Sea.
So we just had the budget announced, and although very little was really targeted to the oil and gas industry, we did have a few nods towards a little bit of investment spent on the infrastructure. So the main one for us is Grangemouth Refinery, and there are two reasons why it's really important. Firstly, we have had, a big degradation in the quality of our refineries over the last 10, 20 years. So it's quite important now that we're getting the attention of the government to start spending a bit of money and upgrading. Of course, a lot of this is going towards the renewable push, etc. But predominantly the energy security, the UK really needs to be able to rely on its own refined products rather than importing them in and essentially exporting this heavy fossil fuel and importing renewables. So there's a bit of focus there. And then secondly, why it's important for oil and gas and the North Sea specifically is because Grangemouth is a huge refinery. It's able to take a lot of 40s oil, which is a direct stream into North Sea, so dated Brent. So the more you can keep that local, the costs are lower, and it should be generally a positive benefit for the oil markets, especially locally in the UK. Now, the reaction we saw on the wider oil contracts is very muted. There are a couple of reasons for that. We don't tend to see the oil swaps markets really move with investment nods. So perhaps the equities will probably move a little bit more. So the owner of Grangemouth is INEOS. So perhaps, their equity profile perhaps rallied a little bit. But for the oil prices, there was very muted action. I think everyone is right now more focused on what's going to happen with this Russia-Ukraine result.
Manny, thanks very much. And that's it for today's special edition of Flux News on today's budget. Thanks to all of our guests and certainly thanks to you for watching. Remember, you can catch all our Flux News output on flux.live or freemium or on our website, on the QR code, whenever you want. Bye-bye.
and welcome to today's morning market on close. My name's Will from The Officials, taking you through today's Singapore window. I mean, looking at Brent flat price, there's not much excitement out there, folks. It's really range bound. We have started to establish a little bit of a down channel if we draw the tops here on the chart. But we're starting to test that upper support, that upper resistance, actually. So perhaps we break higher. Who knows? But it's certainly starting to seem, it seems a little bit heavy to me. And that's true if we look at Brent spreads as well. For a while, we had a pretty strong rally in Brent spreads, up to 70 cents a barrel. But that seems to have turned over a little bit. And we're now kind of testing that 55 cents a barrel support there. And it looks like that could go lower. And I mean, if we're looking at the kind of the east-west as well, so Brent Dubai, it's pretty range bound. It's especially in the boxes. If we check out the box here on a relative basis, structures, they don't want to move that much. But what has been more interesting is news in Asia over the weekend, over last night actually. We got the import quotas for Chinese independent refineries. That's the first batch for 2026. And they're at least 7.4 million metric tons. That's up over around 1.4 million metric tons compared to the same time last year. And that will lend itself that will lend some support for structures in Dubai. So if we pull up the Dubai physical premium chart, we see we kind of bottomed out at that kind of 50 cents a barrel level there, and now we're trading above 80 cents a barrel this morning. Like we said, the import quotas will lend support to Dubai structures, but really it's the same players in the window. The Chinese are still set on the sell side, and Trafi and TOTS are still leading the buy side. It's towards the end of the month now, so we don't anticipate much to change, but stay tuned for the new window next month.
and welcome. This is the first and the only magazine show with the latest news and information from the UK energy scene. Oil or diesel, wind or solar. It's all here in the next 30 minutes. And on the show this week, as an American peace plan emerges between Ukraine and Russia, global crude prices fall. Is this a blip or the start of cheaper oil for all? In France, a huge reservoir of white hydrogen is discovered. But will recovery and deployment costs outweigh any benefit from potential savings? And the verdict on COP30. More hot air than real-world policy? With the words fossil fuels barely mentioned, did any roadmap emerge to allow poorer countries to move to a carbon-free future? Well, all that's to happen in the next few minutes. Joining me to discuss this week's events, Greg Newman, Chief Executive Officer of Onyx Capital Group, and Julian Keyes at Flux Markets. Welcome to you. So let's get straight into the idea of prospect of peace. The war between Ukraine and Russia might be moving to its final chapter, but it has had a real-world impact, hasn't it? What have you seen on the screens?
Yeah, it's been, well, first we need to get the context that only a couple of weeks ago we were thinking this was going to cause a skyrocketing in prices. The market has seemed to think that they believe when Trump was renewing these conversations about trying to put pressure Ukraine to come with a peace deal, that actually that was going to happen, which surprised me personally and us here. So the market's reacted by selling, and the prices are actually quite a bit lower than they were on the just a couple of weeks ago. And there's a bit of panic out there. Do we need to unload everything? And the producers who produce a lot of oil, there's quite a lot of hedging going on. It all kind of makes sense. We're thinking that if the sanctions are withdrawn, which with Trump, these kind of things can be overnight, even though I said it probably won't be. I think
it's literally on a whim, isn't it?
Yeah. Well, it's impressive in a way because it's in, usually you expect an agreement to be just decades. I mean, look at the Brexit bill, look at these things, they take so long. But with this, he's very clearly said, at least in the original 28-point plan, if this is agreed, it doesn't have to be implemented. It just needs to be agreed, and I'll remove the sanctions, which really is a trigger that suddenly there's 1 billion barrels of oil on the water right now. Now, that's not all oil that's just sitting there. There's a lot just transiting, but quite a lot of it, at least a few 100 million barrels worth, is just there sanctioned and not being able to go anywhere. So if the sanctions are pulled away, bang, it has to go find a home. And if people remember COVID and we had negative oil prices, it's not unheard of that could happen again, because there's just so much in the spot market that would become immediately available. So it could be a complete capitulation of oil prices, but it's very we've got kind of forecasts that could be 75 plus oil with if sanctions get tightened and everything unwinds, all the way down to $30 and below. So it's a really crazy interpretation of the market right now.
Well, it's interesting because JP Morgan put out a report saying that we might see global oil at around $30 a barrel. Yes. What was their reasoning, Julian?
They said they were coming from the point of view of the course of the next 2 years. They were saying that there's been very healthy uptick in demand, about 1 million barrels, give or take. So demand's actually increasing, but actually supply is outpacing that demand, about 3 million barrels, according to their estimates. And particularly interestingly, focusing on, or one bit I picked up out of the report, they didn't necessarily just focus on that, is Argentina's oil shale, Vaca Muerta, which is relatively cheap to produce, cheaper than the US, and is very light and sweet, so it's very valuable crude.
Now, Argentinian shale oil has been talked for a long time.
Yeah.
Their reserves are some of the biggest in the world, and they kind of
huge.
rival Saudi Arabia when you get to the deep shale reserves. So that has been like a long-term, if Argentina would be able to get this out, it could be a hugely significant thing, and it's finally starting to happen. It's
It's about 500,000 barrels a day, isn't it, at the moment? It's ramped up from about 100,000.
Looking at Guyana as well, these places that suddenly commit to oil production, it could just really, really go up, and it comes back to
Brazil, Ghana.
It could be happening in the North Sea if we wanted it to as well. But anyway, is that the base cases for them? Is
they're saying 30. For me, more really, I mean, predictions are predictions. They're invariably wrong, right? But I think for me, seeing 30 is a possibility. It's not, as you say, a complete capitulation, too much oil in the water. Maybe you do have a COVID type environment. But I think it's more likely, more reasonable, Ukraine aside and Russia, because I don't think we're out of the woods with that yet. Myself, I think seeing ourselves into the high 50s, low 50s is now.
It's pretty amazing. I think we just end with, we had 2022 and the cost of living crisis and energy prices seemingly the worst thing ever. It has finally flipped on its head and could flip all the way on its head quite aggressively to we've got way too much LNG, way too much gas. If the sanctions are released and things are flowing, we're just swarming with
all the bets are off, really, aren't they?
Well, it's great news for consumers. Potentially.
Right.
Yes, it
now,
is.
I think a smaller order of magnitude, but nevertheless an interesting thing domestically, as we record this programme, we're just minutes away from the budget being announced. And it is thought that there might be an announcement tucked away there, either in the speech or maybe in the paperwork that emerges, is that some licences for North Sea exploration will be relaxed or existing fields can carry on exploration. Will that have a major impact, or is that a relatively small figure in your calculations?
In the oil market? Oh, very, very minimal. But it's good news for tax receipt perspective, and I guess the government is too tempting. But I think you're right.
And jobs. Tax and jobs, right?
They'll bury it away, which I think
they're going to try and get it under the radar. If they approve it. Yeah,
we'll talk about it.
Yeah, we will. I did want to just come back on one point on the Ukraine situation as well. I don't know if that's, I think it's really important to think, for me, Zelensky's shown himself to be a very effective leader, very emotionally intelligent. So him saying he's agreeing to the deal is really to sort of flag up and pique Trump's interest to get him on side. Mm-hmm. But some of the detail of that 28-point plan and the revised plan, because it's now revised, that 28-point plan read like Russia had written it. Right.
No, but you're right, actually, because Ukraine then took it and it was like, this is not what we wanted to see, but they resisted the language of.
They've said the minor details.
Yeah. Russia then said back again.
Yeah.
Well, we just need some clarification. So the language is pointing to.
So I'm not sure, because the war, it is pointing very positively. Let's hope it's all positive. They can resolve it. Absolutely. I wonder whether negotiations collapse. I don't think it'll be Zelensky or Trump. I think it's more likely to come from Russia, because they'll just say
no to any kind of concessions.
Yes. But we'll see.
We'll see.
Yeah, we'll see.
Fingers
crossed. It could be happening. Okay.
Sorry.
Now then, next, news of a giant oil field. This is in France, but the excitement is not about oil. It's about hydrogen, white hydrogen. Early surveys around Focheville show pockets with about 20% hydrogen at a depth of about 1,250 metres. So let me understand. I need you to help me understand white hydrogen. And is that difficult to get out? Is that now doable? Could it be economic to explore that?
Why don't we start with, green hydrogen is how you produce hydrogen using electrolysis. You need a lot of power for that, electricity for that.
Very uneconomic.
Very uneconomic. Blue hydrogen is the oil industry's favourite because it produces
supports their industry.
Mostly byproduct from oil production, right? And it's used a lot in turbines for their refiners to generate electricity. For
and you sequester the carbon dioxide produced by
fair enough. So you've got blue, you've got blue, green, and you've got brown hydrogen, which is more by coal.
And you've got grey, which is again from steam methane reforming, where you're not capturing the carbon emissions for heating up that methane. So white hydrogen, what's white? We've got all the colours under the rainbow here. White is naturally occurring hydrogen. Okay, so this is, if we think about, this is to do with water passing and filtering through radioactive rocks, slightly radioactive rocks. So if you go to Glasgow, if you go up to Aberdeen, there's a lot of radon gas, which is a radioactive gas, in the granite in the buildings there. Right. So you get naturally occurring radioactivity in rocks. So that radioactivity changes the water passing through the rock and splits it into hydrogen and oxygen naturally. And then that hydrogen's very light and it accumulates just like oil, it entraps. And this is what they found, what we call white hydrogen, naturally occurring or geological hydrogen. Key things here are, in terms of development and getting out of ground, more or less, we know how to do this. We've been refining, and we've been.
You can use similar techniques.
You use the same techniques as oil, more or less. How you drill down for oil.
The flashpoint's a bit earlier. You can't have a drill bit.
There are definitely some issues there with that. But in terms of pure economic cost compared to green hydrogen, should be much cheaper. theoretically. And I think it's really important to say that this is pre-development stage.
Sure,
It's fine.
it's a bit of speculation.
There's a long way.
What are the use cases? Because it's not for regular you and me, it's not for domestic power. Is it industrial vehicles, that sort of thing, which might, if they can bring this white hydrogen on board, that's the use case for it, is it?
But like I said,
Good question.
for generating power for refineries, that's a well-known hydrogen cost.
Yeah, well, I think roughly 99%, most hydrogen is grey hydrogen produced at a refinery. And that's really the hydrogen you want to decarbonise. So this white hydrogen has no greenhouse gases associated with it.
Yeah.
Okay, there's no input cost other than pulling it out of the ground. Okay, so really it probably in my head should go and be transported to a refinery to minimise the amount of refinery steam methane reforming. So you're decarbonising that value chain.
I think the point is we need everything we can get, right? We need all the abundant energy we can get, especially if people want it to be renewable. This is just going to add to that mix. I think the big contest for hydrogen is for vehicles. It's just highly corrosive. It's easy to...
very difficult to distribute.
Yeah.
It's very, because you've got to compress it.
Small molecules and escape easily. There's loads and loads of issues. But as I said, the oil industry is hugely into it, really wants hydrogen to boom. It's quietened down the last couple of years about it.
It really has. To 2020, there was a big government to release it was the new thing. Lots of subsidies issued. Actually, there still is a subsidy for hydrogen.
It's just the viability is question. I think if, Elon Musk has actually been a big anti guy about hydrogen. You can't underestimate his impact, right? Because he actually did an April Fool's one day. The Americans don't really understand irony, right? So it was this April Fool's article that they were going to create a Tesla with hydrogen and you were going to get free water in there. And he was taking the piss, but I actually believed it when I saw it first. The point is that he's so like, look, this is just so not going to work. And I think he's been quite damning actually on.
And he's right. If we think of any energy, it needs to be two things. It needs to be effective, right, and efficient.
Yes.
And hydrogen is neither. So actually, it's not a winner at all. So again, you're back to physics and chemistry.
But it's just a part of that jigsaw rather than a major player.
And it does have an area. There is a niche for it. Absolutely.
Yes. Well, another story we must talk about, because that's why we're here in the studio today. A report into regulation of the UK nuclear industry came out earlier this week. John Fingleton was appointed by the Prime Minister to lead a task force to set out a path to create affordable nuclear power generation in Britain and to do it more quickly. Well, the final report sets out some 47 recommendations. We won't go through them all, but amongst the top few, are there too many regulators and scrutinising authorities right now?
So it's not that there are too many organisations, because each of them has a valid role. It's the fact that the way in which each of them adds complexity and the way in which each of them in which they then together have a sort of cumulative effect. So one of the central recommendations we have is that we want to have a one-stop shop where all of these regulatory issues get sorted in one place, rather than having 5 or 6 different fora in which decisions are made in a non-coordinated way. So a system of lead regulation, essentially.
Just a question on the legal challenges. You and your team were clearly frustrated by the number of these, and you want a way to limit them. That sounds controversial. How would you do that?
Well, we've made a very modest suggestion. We've suggested that individuals who bring cases are protected at the moment. If you stop or delay a nuclear project and that costs hundreds of millions or billions, your liability is capped at £5,000, and that's to protect access to justice to people whose rights might be affected by something. We've suggested that limit should go up to £10,000, which I think is reflecting inflation since it was first set. And we've also suggested that if it goes to the Court of Appeal, it should double. We've suggested that if it's crowdfunded, that the limit should be based on the crowdfunded amount. And we've suggested that if a judge decides that the appeal was completely without merit, that they could disapply some of those protections. And we see that as just not limiting access to justice, but trying to introduce some balance into the system. And then we've also suggested that the government should underwrite the building of the continuation of the project pending judicial review, so that these judicial reviews do not stop the building of the project. And that's because if you stop the building of a nuclear project and the whole supply chain sort of stops building, that has a hugely costly implication for the industry and for the taxpayer and the consumer at the end of the day. And we've listed, I think, 7 judicial reviews that basically have been unsuccessful and that most part the court has said did not have strong merits. So these judicial reviews have been used to frustrate things rather than necessarily raise legitimate issues.
Now, the Prime Minister's on record as saying he wants to be builder, not a blocker. He wants to lead a government of builders, not blockers. Are you therefore optimistic that your report will be adopted by the government in full?
Well, I'm very hopeful. I mean, the government commissioned this report. They asked us to be radical. They've made a number of announcements about new nuclear projects. There's a nuclear renaissance internationally. You look at what the Americans and others are doing with nuclear. I think there's increasing recognition, given rising energy demand, the need for investment in technology, AI, quantum, and other technologies, that we're going to need huge increase in energy supply in the UK. Nuclear is has a huge role to play in that, but it needs to be far cheaper and far more efficient. So I think all of those create a lot of pressure on the government to actually get this right, and I would be hopeful that we've set a very ambitious timetable for implementation group that should monitor that implementation on schedule. And we'll know later today in the budget where the government stands on that. But my understanding is the government feels very fully committed to implement this.
I mean, my point about the blockers and the builders, the PM says he wants to be a builder, not a blocker. It sounds like this report is right up his street.
I was going to say, it's really, really positive, isn't it? I mean, there's someone saying, like, here's how you actually do it. Here's deregulation. Here's cutting through the core issues, which a lot of people say is red tape, is bureaucracy. It's a really clever way to get across your point, and I really hope it's taken seriously. I mean,
yeah, me too. I think he's absolutely total proponent, having read through the report this morning. I think, this would save billions for nuclear project building. So there's recently, I can't remember if it's size rolls C or B, whichever one it is. This is about £120 megawatt, so 12p per kilowatt hour, putting it in sort of household terms. That's much more expensive than offshore, onshore wind and gas power production. So to his point, it's very expensive. That's the red tape. Get rid of the red tape. Of course, it still needs to be, and what he's saying is not, and it's a free-for-all, let's organise it so there's a clear regulatory body with total accountability and responsibility for approving. Okay, and it does need to
do the work, but do it once. I think that's one of the points,
exactly.
Do the work,
make
do
it
it
efficient.
Once. It's interesting. You and I exchanged a tweet from Robert Peston about this, which I think we can show it. We'll put it on the screen now. He's worried that actually, far from being accepted, this report might be
kicked down the can, kicked down the road.
Well, you know what government reports, they often just gather dust on shelves and bookcases, don't they? That would be not ideal. Let me put it no stronger than that, right?
I mean, this report did come out, and Robert tweeted this yesterday, right?
Yeah.
And so we got the budget focus today, so I suppose that they want to focus on this. I suspect, let's give them the benefit of the doubt. But just to remind, I think Robert Peston's also a brilliant commentator, really economically sound. He's totally behind it, which makes me, think that's really valid. But just to remind everyone, this is going to increase our energy security by having nuclear power, which runs at a constant rate always. So it minimises our need to burn gas, doesn't get rid of it completely.
But it's pretty much exactly what we need, because people keep saying that the great thing about wind is we're producing or getting more of wind-powered electricity on the grid. And that is great, but it's not solving the issue, which is intermittency. And, that intermittency has been taken advantage of by traders, and those shock price spikes and trade houses profiting from it, that is the issue with wind. So if you increase the base load with nuclear, you reduce that more and more and more, and slowly you're getting there, right?
And you solve that intermittency with batteries and other
Get better at batteries.
Get better at batteries. But
that's another talking point.
The other key thing I want to come back on Robert's point of view there, and you saying kicking, and me saying kicking the can down the road, is this is great for UK economy.
Yeah.
And it's great for jobs.
Yeah.
So I suspect the government will pick up on it. Is my theory.
Okay. Well,
we'll encourage.
We'll certainly watch it and come back and report on what's happening. Some charts. How are we doing on the markets, Julian? What are you seeing on the various prices?
Let's get the charts up. That's a really good question. So the first one we got here, a week or so ago, we were looking at this chart and the government data. So the government are recording sort of about a third, actually more now, maybe 50% of forecourts across the UK. It's the government initiative launched about 2 or 3 years ago. That number here is in the left-hand corner, £1.45 spot 4p. That's last week's average price across the week, across about 5,000 forecourts in the UK.
To be clear, we said, I think we need to explain this, because we've got the pump price estimate here.
That's our pump price.
This is the current pump price. So
yes,
a couple of weeks ago, we said this is going to go up to 151 if prices were going to hold there. They ended up dipping, and as you say, the average was lower, but we did get
the average has moved up.
The average moved up, and as expected. So this is a really good piece of free information for people to use, right? So fluxmarkets.co.uk. And then this, now what we're saying
now we're back down because of Ukraine and various other sort of
we're looking like we're going to head back down again, which is great news, as we said. But it shows the volatility, right? And it's it could be different again next week.
And in actual fact, if we look at government data for last night, it's at £1.46 and a half p, so 1p. That's $12 a tonne, 1p higher pump price across the UK. And we're saying now actually the real value is about £1.43. So we are absolutely
hold tight. If you can hold tight and not drive for a bit, you should save some money in a few weeks.
Fill up next week.
Delay that journey.
Fill up next week, right? And then the other thing
the gas
here,
numbers, I think.
Gas numbers coming up here. UK national balancing point. This Bloomberg chart. We're at 76p per therm. That's equivalent to about 2.5p per kilowatt hour, which is the number most people see. If you log on to your Octopus supply, you're probably going to see it at about 6p. But that number is coming down. And as you can see here, we're going back to last winter where numbers were double at the peak of winter last year. We're not seeing that same effect. Why? Because 2 weeks ago, we were talking about a much colder winter coming, but now they've dialed back on this. There's a big change in the stratosphere, and our gas guru here's just given me a download, and it went right above my head, literally, and in terms of science. But we're now expecting a more mild winter, but actually, so that's a factor here. But we've also got the Ukraine impact here, which also impacts gas prices. But the big one is LNG, so compressed natural gas from the States. We discussed this before, from Qatar, and are heading this way and filling the gap. And the US nat gas is much cheaper than our nat gas, but that, even with LNG, freight and cost, because it is expensive to move it, that's helping compress prices here. So gas prices look like they're coming down. We're not going to have the same expense we had on our hands.
The government can take all the credit.
Yes.
Of course they will. Okay, thank you for the moment. This is the UK Energy Show, brought to you by Flux, the biggest news, information and trading platform for world energy markets, from Onyx Capital Group. Now, next, let's consider COP30, the outcome that was agreed. The bam, bam, bam chant you can hear there at the end of COP30 celebrated the successful agreement and establishment of the Belém Action Mechanism. What's that? Well, the chant was led by the activists and civil society organisations to demand concrete action on a global just transition away from fossil fuels. Well, a little earlier, I spoke to David Jones. He's the chief analyst from the energy data analytics think tank called Ember Energy. And I asked David whether he thought this year's COP meeting had achieved very much.
It achieved some things. Whether it was worth the effort of everyone getting together in quite the way they do is maybe another matter. I think a lot of it is how you lay out expectations in advance. I think people that went into it expecting to get a deal on phase out of fossils were probably going to be slightly naive to the kind of realistic outcome that might be expected from that. And I think to most observers on the ground, it was no real surprise that there wasn't a completely global agreement on that. What there was on that was some really good commitments or from governments to kind of step in to look at how to get off fossil fuels at a national level and to work with other countries on that, which is really exciting and kind of what needs to happen, and probably the only way that is going to actually happen.
Do you get a sense that almost despite COP, actually some of the scientists around the world and some of the forward-thinking businesses around the world are just getting on with this climate challenge and the move away from fossil fuels because they can see there's a buck to be made in investing in renewables, solar, wind, whatever it might be. And there's kind of progress being made almost despite what the politicians are arguing about.
Absolutely, and one of the biggest ironies when you look at COP is the blockers that Saudi Arabia put in the way, and then you look at the ground of what's happening in Saudi Arabia at the moment. Actually, they're one of the biggest installers of solar and battery anywhere in the world, as they look to expand that. So there are big differences in terms of what people are doing on the ground and what they're saying in that, and they work both ways.
China too, I think that could be applied to, isn't it? I mean, I know they're still polluting and I know they're still using a lot of coal, but they're also building solar with the graph almost going up vertically in terms of the amount of potential and the amount of capacity they're putting in place.
Yeah, this year's been, out of all the stories for this year in the global energy field, I think that the rise of solar and wind in China have been the main one. Over 2/3 of solar installed this year globally was in China. The same for wind. Everyone talks about solar in China, but China is also installing 2/3 of the wind with the wind capacity for this year as well, which is huge. There's a question to which extent they're then serious about bringing down emissions as well. So I think that what's clear now is that they're around about the peaking of emissions. Which is super cool, super exciting, and a huge step away from what's happened over the last 2 decades, where so much of the rise in emissions has come from as China has really seeked to develop. And what's really interesting now is to see where they might go with their own emissions trajectory, how quickly they carry on building out, how much they value efficiency that will actually lead to a reduction in fossil fuel use. I mean, it was interesting to see them at COP because actually then, although they're doing a lot of all of that stuff on the ground that's happening, they're not that engaged in trying to push the conversation further on phasing out fossil fuels. And so it's still uncertain quite how they sit within that. And I don't think that you can necessarily characterize all of their efforts as intended to be reducing CO2. They've obviously got half an eye to it, which is quite cool, and they are going in the right direction in so many ways, which is super positive. But now it's really about that trajectory that with over half of the world's coal use coming from China, how quickly can they start to get that down?
And just a thought about America. Trump wasn't there. American delegation wasn't there really to any large extent. Did that matter as it turned out?
If anyone was following the international maritime talks last month, and you could see how disruptive the US was being to try to tear apart that as a multilateral organization. Some of what happened behind the scenes reported in the FT was really quite scary and like bordering on gangsterism, and the actual mission from the COP talks to some extent didn't then get in the way of some other discussions. There were enough other people that wanted to veto a fossil fuel phase out with Russia and Saudi and others without the US needing to be the ones to take that onto their shoulders. So I see it as really quite useful. I think that it showed that multilateral, like when you look at how people are reporting back on COP, I think that there is a real sense and surprise that in this day and age, people even want to get around the table to talk to each other. So in some ways, people are reporting on this as a success in part of multilateralism. When it hasn't got the strong results from it, you kind of question how useful that is. But it's nice to see the multilateralism isn't completely dead in this day and age of Trump.
Could we just zoom right in on the United Kingdom just for a second? As we record our programme today, the budget hasn't been announced, but boy, oh boy, there's been enough rumours as to about what might be contained in it. If you had a wish list, David, what would you want the Chancellor to include in her measures, particularly relating to energy consumption and energy use?
I'm a simple person. I only have one wish. My wish is for cheaper electricity. I think that that what will come through some of the discussions within the budget will be around heat pump grants. There'll be around EV grants, which are very interesting. But really, if you're going to get people to want to heat their homes with electricity and drive with electricity, what you need is cheaper electricity in the first place. And what's happened within the UK as we've gone through the legacy, the way that we've built up our electricity industry and our pricing, we've ended up with all these kind of legacy costs added into electricity bills. And they're particularly crippling and leading to very high electricity prices. And there's no reason why, there's all sorts of reasons why they should be taken out of the electricity bill in themselves to lead back to actual more representative cost of what electricity costs today, which is substantially cheaper. And only by doing that are you really going to get the economics right, that people are going to want to think about heat pumps, EVs, and more critically, people can afford to heat their homes in the first place. And one of the kind of the alternatives is being discussed around VAT cuts and things like that really come back to in part come back to fairness and affordability. If you could other ways to make electricity cheaper, the fuel poverty is worst among people who heat their homes with electricity. Cutting electricity bills seems like the fairest option.
So that's it all done. Next time in Turkey, which is an interesting country, I looked it up. They still burn tons of coal for their energy, but they are going steaming ahead into solar, according to one analyst anyway. This year, was it a waste of time, money, energy going there?
I was going to say Turkey are huge diesel users though. And I think when we talk about fossil fuels, it's always on the forefront of everyday people's minds, isn't it? That it's the cars, and it's just like, that's on its way out, I think. I personally think it's not going to take too long. It's shifting focus to diesel usage for agriculture, for transport, proper transport, for road freight. And that's not going anywhere, I don't think, for the time being. And I think petrochemicals, plastics and all, that's got to be a new thing to figure out. So for me, it doesn't mean anything, to be honest. And I think actually, if anything, it's going to get worse and worse from Trump. As soon as he's done with Ukraine, Russia, if he is successful, he will turn his eyes, in my opinion, back to trade, global trade, and will want no restrictions. And I think the CBAM, the border adjustment mechanism, will be his focus. I think he's going to squeeze Europe to get rid of that kind of thing. And I think in general, COPs are under a lot of pressure. I don't even know if it exists.
Barely relevant.
Barely relevant. But on the flip side, like everything we've just spoken about with nuclear and these proper progressive plans that actually seem actionable, that's how you do it, right? You don't all get together and talk about it. You just implement. And I think we are so far down the road that all the backlog of the last 5-6 years of investment will steadily come through and iterate. And I don't think there's any point in taking a backward step if these things are in motion. It's just trying not to go all in on 1 year, which is what, again, previous years we've tried to do. That's my take on it.
Yeah, I think so. From what I studied and looked at was Ed Miliband's point of view, which is really, I mean, we have legislation to get to net zero, right? You've interviewed Richard Tice, who says, net stupid zero. Miliband's still very much on that progression to get to net zero. Okay, and he's going to focus on job creation, and this is the right strategy to go. Now, those two things, as true as they might be, the big problem here is we're seeing, as we just saw on the gas price just now, that's 2.5p a kilowatt hour. Whereas at the moment, I've just changed my own personal power supply, electricity supply to Octopus on their Intelligent Go tariff. That's 30p at peak. It's it's more than 10 times more than the equivalent natural gas base cost, wholesale cost. So there's this big disparity. What I'm trying to say is there's a big disparity. All those policy costs coming to the power price, the electricity price. And so I think, Ed, and the government need to think about slowing down the transition. The transition's got to come. I'm a proponent for that. But they need to think about how they make this more equitable and slow it down.
By the time we meet again in a week, we'll know more about what's in the budget, which, as we record this, has still not happened. Oh, and by the way, you can see the Onyx hot take on the budget measures. Just search for the budget special from Flux News on YouTube. Lisa Aziz will have all the latest information about what the Chancellor said and didn't say. That'll be dropping on your feed around about 6 o'clock tonight at the time of publication. So thank you for watching the UK Energy Show. Don't forget to click the subscribe button so you never miss an edition of the show. Any thoughts or feedback, post in the comments below.
comes to risk management, when it comes to taking profits, unless you work in a mechanical system, each individual will have a different risk tolerance, and therefore there is no one size fits all.
Welcome to another episode of Inside the Mines. I'm Chris, Head of Client Management here at Onyx Markets, and today I am joined by New Squawk's very own Mehul Patel. How are you, sir?
Yeah, good. It's good to be here, Chris, and it's good to come and speak to you and talk about, I guess, my background, but also the exciting stuff you're doing at Onyx.
Fantastic. And before we get started, please do like, share, and subscribe. Really does help the channel, and feel free to leave comments of anything in particular that you want us to do. Please let us know. So I think if we just start from right at the beginning, what initially sparked your interest in trading, and how did you get started?
I guess I started trading at university.
How many years ago?
1999, I think. But weirdly enough, and I guess a lot of my trading career has been around arbitrage.
Okay.
And so I remember Barclays stockbrokers used to have an online platform that used to hold your price for 15 seconds. And so you could trade economic events, but with a price that was held. And so
they quote you a price in 15 seconds.
They'd quote you a price, there was a timer that went down. And so if you traded around an economic figure, and whilst it wasn't futures and options, but even shares around there, you could make, a decent amount of money for a student. And so, started at university. And then throughout university, I worked for probably one of the world's largest companies that no one knows about, a company called Cargill.
Okay.
That does commodities trading, commodities processing. And so, from the end of my first year all the way through university, worked for Cargill, more in tech and plugging PCs in and doing sort of manual labour. But you learn a lot.
Coffee runs.
You learn a lot because you're on the trading floor. And so, worked for Cargill all the way through university. And then my first job after university was with a small options trading company called Nordic Options.
So then what made you, being on the tech side for a trading firm, what made you want to be, I want to be a trader? Was it
money?
Money. Seeing how much they got paid?
It's money. And, you watch movies when you're young or whatever.
Yep.
But also, I think the competitive nature of it and the fact that there's a finite result. So, there's no, for want of a better word, bullshit. There's no corporate hierarchy. No one cares. As long as you make money, you get rewarded.
It's your P&L at the end of the day.
It's your P&L. There's no, there's no corporate politics or whatever.
Yeah.
As long as you make money, you get paid. It's a very definitive outcome.
I don't, speaking to, traders in-house here at Onyx, and, even our CEO, Greg, who, was a trader. So he always goes on about, you can lose money in this game, but you can lose well. If you stick to a process, you can still lose money, but lose well. And that's someone you could always keep around if they stick to the process.
I think so. And I think sticking to a process is one thing. I think as the markets have evolved, technology's evolved as well. And so I think you've got to keep up with technology. And, I, inverted commas, stopped trading at the back end of 2014, 2015, professionally. And effectively, I became a bit of a dinosaur as a quants and the programming languages came in. And, yes, you can stay in the markets, but you have to evolve. And if you don't evolve, you get left behind.
Yeah.
The good thing is, with the number of tools available now, that's actually never been easy.
Yeah. I mean, so then would you say that was one of the biggest challenges you faced early on?
Yeah.
The evolution of it?
I think the biggest challenges early on were just information flow. So, if you trade and you trade professionally, you're inherently always going to be at somewhat of an information disadvantage than traders at banks, hedge funds, etc.
Yeah.
And so it's for you to make sure that you get as much data or as much tooling as possible to level the playing field. And so the more effort you put in, and the more tooling you give yourself, the better the outcome. It's like anything else, whether you're a sportsman or whether you're a racing car driver, it doesn't really matter. The more you practice, the better you get, the better tooling you get, the better you get. And you have to understand the fundamentals. People look at lines on charts, is it going up or down? But fundamentally, there's a reason it's going up or down. Maybe it's flow, maybe it's a merger or takeover. It could be a new product release. It could be one of 100 things, but unless you have that information, all you're looking at is a line on chart. And that works for some people, but for me, I needed to know why stuff was moving.
And did that translate into, what you do now and, the company that you have with New Squawk?
I think so. We started in 2019, and I got approached by a really good team of analysts that were working somewhere else that wanted to set up something new. And I'm really fortunate to have a team and work with a team that has a really good understanding of the markets. And, on a sort of daily basis, it's like, what else can we find? What other data, what other information, what technology, especially right now with sort of AI and machine learning, can we use to both better inform ourselves internally, which then helps us better inform our customer base.
Yeah, and I mean, for the clients out there that do trade in Onyx markets, New Squawk is a service that you do have available for you in the platform, and it is available on our premium service as well. So please do reach out to your account manager. We are here to help you. You're more than welcome to reach out to me myself. I'm very happy to help you, walk you through it, and we can take it from there. But if we go back to when you first started, did you have a mentor at all? Anyone that kind of guided you? Put the stabilizers on the bike.
A guy called Mike, who was a very, very angry American, but a super good guy. And I guess I was the last sort of generation of the sort of school of hard knocks, learning how to trade. So I knew that if I got a phone call at 7 a.m. on the way to the office and Mike wanted a black coffee, he wasn't in a good mood, or his position was the wrong way round. And occasionally having the odd calculator thrown at your head was fairly normal in the office, but you learn very quickly. And in fairness to him, the amount he taught me, and used to say very good things behind my back to people in the markets and all that sort of stuff, but it was definitely a learning through the old school of hard knocks, as if it were.
So then how would you say, your trading style started versus where it ended up by the time you ended your trading career?
So I think because Mike was so about the details, and when I was trading effectively futures arbitrage. So the Euro stocks, 50 biggest stocks in Europe against the DAX, with 40 biggest stocks in Europe against the CAC, AEX, MIB, IBEX. So it was drilled into me really early. What stocks are in each index, what weight does each stock carry in each index, and therefore if a piece of news about, let's say, Deutsche Bank, which was a lot bigger then than it is now in market cap, came out, would it affect the DAX more than the Euro stocks? Which one was likely to move more than the other? And if that move hadn't already taken place, or it had been exaggerated, trading it back into line.
Yeah, and that's something we try and relay to clients all the time, because you might be trading the index, but especially let's say for the DAX 40, if you don't know what the constituents are and what weighting they have, like the top 12 of the 40 and the DAX have over 50% market cap of the index as a whole. So if you know where the top 12 are going, you kind of have a handle on what's going to happen in that market.
But I think even more sort of even more wider than that, the cash in Europe shuts at 4:30, whereas the cash in the US is still open until 9 o'clock.
Yeah.
And therefore, and then you have earnings announcements after 9 o'clock. And I think, as most traders know, global markets generally follow what the US does. And so if you have big US earnings, be it tech or be it any other automobile industry, any other, understanding what's happened between 4:30 and 9, or 9 and the next morning when the European markets open, is super important. Otherwise, you're effectively trading blind in the morning.
So what would you say that you had a checklist when you were trading? Was there any criteria that you needed? I know you were spread trading between different indices.
I think it was just information. were their earnings out? Have there been any notable moves in any of the sectors? What economic data releases are due throughout the day? And so something like non-farm payrolls or CPI, which moves markets significantly, whilst I was never trading them directionally, what it would provide is the opportunity for very short-term mispricing between different indices,
With the volatility.
which you could take advantage of.
So then, can you walk us through your worst losing trade?
Yeah.
And your most profitable. Let's start with the worst losing position or worst losing trade, sorry.
Worst losing trade, 2008, I think it was.
Financial crisis.
It wasn't financial crisis, made a decent amount of money trading volatility around the financial crisis, which answers your question as to the best trade or the best trading period. The volatility around the 08 crisis provided a lot of opportunity over several months.
What market was you trading?
European and US index futures. What's notable now is that volatility, which lasted several months during 2008, as the markets become more and more efficient and more entrants have come into the market, the period of volatility has decreased. So something that took 3 months to price in back then probably gets priced in a week now, or maybe shorter. Going back to the the worst losing trade, I was short the DAX the day that Volkswagen became the world's most valuable company, if you can believe that. So there was a...
So Volkswagen became the world's most valuable company. Volkswagen was part of the DAX.
And I was short the DAX.
And you were short the DAX.
Yeah.
So how much did the DAX rally by?
A lot, relative to the Euro stocks. But I think Volkswagen at one point became, throughout the day, was worth about 300 billion euros because of an event around Porsche taking control of Volkswagen. A lot of hedge funds being short the stock, so they had to go into the market and buy the stock as the price went higher and higher, which only pushed the price higher and higher. And I was the wrong side of that. So that was a very, very painful day in the markets.
Did that loss teach you any lessons? Did you do anything differently after that?
Yeah, I guess one of the things you learn is the market can be wrong longer than you can be solvent.
Yeah.
And therefore, in hindsight, Volkswagen was never going to remain the world's most valuable company. However, it could longer than my margin allowed me to stay solvent.
Yeah.
So, yeah.
Now I definitely know what your favourite trading quote's going to be. So, I mean, through those highs and lows when you were trading, how did you handle those emotions? Anything that you did, anything that you could, say that worked or what didn't work for you on the emotional side?
I think just understanding what works for each individual trader. I don't subscribe to this, if you do this, this and this, you will do well or whatever. Ultimately, when it comes to trading, and I think most traders will recognise this, what my stomach feels like when I'm making money or losing money is very different to anyone else. And what you do throughout the trading days, I've got friends who will sit there for 15 hours a day and not leave their screens. I didn't trade like that, and I knew the periods of the day where my markets were likely to be busy. And, the rest of the time it was like go for a walk or go to the gym or whatever. I have other friends who were somewhere, or the pub. There were other people that did things differently. So you've got to do what works for you, and what, when it comes to risk management, when it comes to taking profits, unless you work in a mechanical system, each individual will have a different risk tolerance, and therefore there is no one size fits all.
So then on the risk management topic, I mean, did you have a set determined, appropriate level of risk that you'd like to take per trade? Was it a percentage of your balance? Was it a risk to reward ratio?
No, it was relatively flexible to the market moves, and therefore if something was considerably risk priced, you'd put more on, and then you'd keep capital to be able to average in. Whereas if something was mildly mispriced, you'd probably put a smaller amount on. So it's all about risk reward and understanding the movements and historically how much something can move. And obviously you can be wrong like the Volkswagen day, but on over a period of a year or 2 years or 5 years, where those tolerances are relative to your risk tolerance and relative to the margin that you have.
So if you could give one piece of advice to either your younger self when you first started trading, or for those watching that are just starting, their trading journey, what would that one piece of advice be? And you can't say listen to New School.
Just learn as much as you can. Learn as much as you can about the products that you're trading. I've never traded gold, for example, but if I was going to start trading gold today, yes, there's a chart of gold on a chart, and it may go up and down. But what time's the gold fixing?
Yep.
What times? When is production announced? Is there any other information out there? Are there any global macro or geopolitical events which mean that gold's becoming more and more popular?
Yeah.
If you thought about gold 15 months ago or 18 months ago when the Ukraine conflict started, it's generally going to go in one way whilst there's times of uncertainty. And therefore, if I was going to trade gold from today, would I generally go, I'm going to trade it, but probably only from the long angle? So if there's a dip, I'll buy it, sell, but dip. So I think having an understanding of short-term moves, but also the longer-term global macro play is important.
But I think that speaks volumes in terms of, I'm sure you had it when you were trading on your desk. You'd never really have someone that, retail participants, they would trade every single market 24 hours a day because they can.
Yeah.
Whereas if you strip it back and go, right, well, I'm only going to focus on the DAX. All I need to do is get a handle on those 40 companies and what they're doing, and I'll have a handle on the index. I don't need to worry about this. I don't need to worry about that. Obviously, there's other things you need to worry about, but having a position in euro dollar, then having a position on the DAX, and then the S&P, and then gold, and then oil at the same time. It's all over the place.
There are some people that have the ability to do that, and I've traded with people that will have 10 different products up on their screen, and they're able to just trade price movement. It doesn't matter what the asset class is. It could be, cocoa, grains. It could be jelly beans. It genuinely doesn't matter for them. It's like the equivalent of, and probably not the best analogy, but playing a video game. It's just numbers on the screen to them, because their brain works that way. Unfortunately for me, mine doesn't. Whereas I have to know what's driving the movement, and so again, there is no one size that fits all.
And then when you're first starting out, I definitely think, from speaking to yourself and other guests on the show, is definitely strip it back, focus on one thing at a time, and take it slow.
I think learn as much as you can. I think these days, with the amount of content, both good stuff, so educational videos, videos about technical indicators, videos about how indices are calculated, videos about how commodities are priced. There's a lot of good stuff on the internet that you can watch and follow and read. But there's also the, should we say, more junk end of the market, where it's more, do this and you can get rich quick, and that end of the market. And that's obviously become more and more prevalent as social media has become more prevalent. People in Lamborghinis in Dubai going, you'll be rich and
join my trading team, add to the WhatsApp channel.
And you've just got to sort of think to yourself, if somebody had a system that was right 70% of the time or 75% of the time, would they be selling that system on Instagram for $100 a month, or would they be working for one of the world's biggest hedge funds making a lot of money?
Of course.
And so yes, there's again, it just goes down to, it doesn't matter what industry you're in, unless you're willing to put in the work, the chance of you getting rich quick.
You've got to build those foundations. Exactly. You definitely have to build those foundations. Well, it moves us on to our quick fire round. So I'm going to fire some questions out to you. I want to know the first thing that comes to your mind. Okay, so favorite trading book?
I've only got one book, which is called Options, Volatility and Pricing, which was the first book I got given. I prefer more global macro books, stuff written by someone like Jim Rogers, which tell you about how the world's going to move in the next 5-10 years, or whatever.
Favorite trading film?
Trading Places.
Favorite technical indicator, if you have one?
I don't use technicals that much, but I do like Renko charts, because they take away the noise and only show you movement, so they take away the time element.
Favorite economic data release?
Anything that's volatile. So you went through a period where non-farm payrolls was the Super Bowl. Then you went through a period where CPI was the Super Bowl. Anything that creates volatility, which then creates opportunity.
Favorite asset class?
Equities or equity derivatives.
Favorite product? individual products. So the
Uh,
DAX.
I guess I've traded more of a DAX in most things yet.
One market you avoid at all costs.
Metals. You're at an information disadvantage.
Okay. Most memorable market event. Volkswagen?
For all the wrong reasons. September the 11th, I was a junior at Emron Metals, so yeah.
One word to describe your trading style.
Measured.
Like it.
All boring.
Yeah, we'll go with measured. If you were to have a trading nickname, or you did have one, what was it, or what would it be?
Yoda Futures, which was given to me by my good friend Toxic Tom.
Toxic Tom gave you Yoda Futures. Any background behind that nickname, or?
My kids might watch this video. So.
Okay, we'll keep it there. If you wasn't a trader back in the day, what would you have been?
I don't know. I guess even from a young age, I used to work on the bingo hall on Brighton Seafront from the age of 12. And that whole concept of buying, selling, doing something where...
You could have been a broker.
I could have been a broker. So, yeah, it was always going to be something along these lines.
Favourite trading quote, which I know you've already given us, but...
No. My favourite trading quote is actually, if in trouble, double, but don't.
Think trouble, double?
If in trouble, double.
Oh, if in trouble, double.
But don't.
Okay.
It was
Who's that quote from?
It was a running joke in the office.
Okay. One skill every trader should master.
Discipline.
Well, that does bring us to the end of those questions. But for those that want to find more about New Squawk, they can. Where can they go?
Newsquawk.com. You can sign up for a trial, and equally so with our next markets, you'll be able to have our content on their platform. We have if there's anyone new to the markets and you want an extended trial, reach out to us. But even if you're not trading or you're about to start trading, just read like the European opening news, the US opening news. We break it down into different asset classes so you get that sort of global macro view of markets, and it helps you, begin to connect the dots.
And please do like, share, and subscribe. And until the next episode, Mehul, thank you very much.
It's been a pleasure.
Hi everyone, I'm James Brodie, Head of Learning and Development here at Onyx Capital Group, and I'm delighted to welcome you to this immersive course on commodities and financial markets called Trading with Discipline, where we take a deep look into fundamental analysis, technical analysis, behavioural finance and risk management, all based on our one-day accredited programme with the Singapore Institute of Banking and Finance. Across a series of webinars, we'll explore the fundamentals of global markets, starting with an introduction to commodities and energy trading, before moving into key drivers of market prices through fundamental analysis. We'll also provide a clear overview of bonds, equities, and foreign exchange markets, ensuring you have a strong cross-asset understanding. We'll then dive into technical analysis, including trend following, mean reversion, risk management, and program trading strategies. We'll also examine the increasingly vital role of behavioral finance, helping you understand trader psychology and emotional discipline in real-world trading. The course includes interactive trading simulations powered by Amplify Me, multiple choice review tests throughout, a final end of course exam, and a certificate of completion. This program is ideal for anyone looking to develop a deeper understanding of financial markets, sharpen their trading instincts, and build real practical skills for the industry. I look forward to seeing you on the course.
Hi everyone, I'm Stuart Mitchell and I'm a senior energy analyst here at Onyx Commodities. I'm delighted to welcome you to this immersive course on the European gas market. The European gas market has changed more in the past 3 years than in the previous 3 decades. From the collapse of Russian pipeline supplies to the explosive rise of LNG, the story of Europe's gas is one of transformation, volatility, and resilience. In our Explainer series on the European gas market, we break down everything you need to know, from demand, supply, and storage, to how gas prices are formed and why they move. You will learn how weather drives heating demand, how gas competes with renewables in power generation, why storage levels matter, and how Europe rebuilt its energy security in record time. Whether you're an analyst, trader, policymaker, or just energy curious, this series gives you the insight to understand what's really powering Europe today. Watch the full Explainer series on the European gas market and see how the continent's energy system is being rewritten in real time.
Well, hello and welcome to the New Look Hedging Show. I'm Lisa Aziz, your host, and sitting alongside me for today's illuminating session are Harry Campion-Evans and Julian Keats, along with all of their expert knowledge. Morning, guys.
Good morning.
Good to see you. Actually, just firstly, Harry, Julian, tell us all a little bit more about yourselves and your particular roles here at Flux Onyx.
So I've been with Onyx since 2016 when the company started. I started in the oil markets back in 2014. And my background is trading for around 7 years and then broking and sales for about 4 years. And then as of this year, I'm now a director on the Flux Markets business, kind of back mainly training, focusing on the trading side.
Brilliant. Julian.
Hi, Lisa. I spent about, I couldn't believe it, 40 years in the industry, originally a geologist looking for oil in various different locations around the world, and then moved into trading energy and oil, physical and derivatives, and the blend of the both. And I love the industry. It's a great industry, so interesting. There's always something changing. And I'm really particularly enjoying this sort of transition we've got to renewables and moving away from traditional fuels over the course of the next 10, 15, 20 years.
But you've seen some changes over the years.
I absolutely have seen a lot of changes over the years, and all good. all good.
Yeah, we're going to go into some more of that naturally. Let me tell you exactly actually what the Hedging Show is all about. Each week, we aim to dive a little deeper into a different segment of the oil market and talk about recent dynamics. So in the next 30 minutes or so, we're going to be having a look at how the latest market news and industry trends are impacting prices, how it all impacts relevant industry and business, and we will bring you expert advice on how to structure a hedge using derivatives. So an awful lot to cover, though. Let's get stuck in. Actually, Harry, Julie, let me ask you just firstly, though, your own thoughts on a particularly big issue that's emerged over the last day or so. JP Morgan issuing that key research about oil heading for, say, $30 a barrel. What do you make of that?
Well, well, I mean, I suppose with the bank research, you know, they're always trying to, they've got an agenda and they want to make sales and say kind of like shocking things. Like back in like recent years, you know, they were big proponents of like oil could go to like 300, 400. But I think from what I read in this research, their sort of more conservative figures for next year was somewhere in the 50s. But maybe you read it with more detail than me, but as I understand it, they were saying that, you know, if with current kind of demand levels, if supply isn't cut, then oil could be heading for $30 a barrel by 2027. That's what they said.
That's pretty much broadly the summary. Yeah, they're saying demand is growing about 1 million barrels, somewhere roughly 1 million barrels a day, so 105 million barrels a day. And actually, when I first started in the industry, it was about 73 million barrels a day. So that's a while ago. So it's grown a huge amount, right? And it still seems to be growing. The only year it's really fallen is 2020. But the key thing is that demand is growing, but supply is outpacing demand, according to JP Morgan. So Keynesian model, supply and demand dynamics, price should go down. And yes, you're right. They're really saying, if we really look at this, you know, earlier this year, they were saying maybe we're going to go to 127 on the back of the Middle East conflict and the bombing campaign back in May. And they did caveat that research if it continued. So yes, you're right. Banks can flip-flop around as the market changes. But actually, if we look at the trend, it is very weak for crude. It has been downwards. Does it get to 30? I think I'd probably grow my hair back if it does. I suspect testing lower is a possibility.
Are we wrong then to take such notice of a report like that?
Not really, because I think the data behind it and the like facts behind it are worth keeping in mind. I mean, there is a lot of oil on the water right at the moment.
Yeah, there is. There is.
And there is kind of a lot of potential for that imbalance to kind of grow and get worse, and that is what would happen in that situation. So, yeah, I don't know. I mean, it's hard. You can't say they're wrong or right, but yeah, I
think they presented a logical argument.
Yeah,
I think. Yeah. So, but things can change, right? And they can change tomorrow. So it's a prediction.
Yeah.
And I think we do need to take attention because shale oil in the US, everyone thinks the US, but actually in Argentina, it's growing substantially. It's gone from 100,000 barrels a day to 500,000 barrels a day. And it's very cheap to produce their shale oil, much cheaper than the US. So there is pressure on the production is increasing, and we are seeing pressure. And also, let's not forget the Russian situation. That even though Russian sanctions are imposed, people tend to work out a very good way to obviate them. I'm not encouraging that, but that is the reality. Past shows that Russia and other countries can manage to obviate these, even at a significant discount. That means their crude is still on the market.
And also, as we are on air today, in the background, you know, the talks are going on in quite some detail now about ending the Ukraine-Russia war. So wait and see, of course. Crude then might be down, but what about, say, the gas snap situation, which has really been on a rally, hasn't it, since the summer?
Yeah, along with the gasoline market in general. Yeah, I mean, it's just been like one issue after another for the gasoline market. You've had just like a really unseasonal, unprecedented like move in the winter contracts especially. But yeah, I mean, we talked about it a couple of weeks ago with the kind of multiple refinery outages, like really strong demand, kind of depleted stocks, and then just, you know, sanctions on Russia. So just, yeah, it's been a kind of bit of a perfect storm. And you've seen that, yeah, just enormous rally kind of in the summer and since the summer, and still, I mean, we're kind of almost in like kind of getting towards peak winter. And yeah, we're just seeing, like we said on the gasoline cracks a couple of weeks ago, just, yeah, really unseasonally abnormal high levels of gas. yeah, it's just kind of speaking to the whole gasoline complex as a whole. So yeah.
Maybe we should just frame for the viewers what the gas nap is, because it's kind of oil market lingo, isn't it? Gasoline, the difference between outright gasoline price and naphtha prices, and that is the gas nap. So it's the spread. As gasoline prices rise, as they have done in the last few months, naphtha prices haven't risen as fast, so that spread's increased in value.
And why do we refer to that spread anyway? Is because gasoline is a blended product. So the gas, when you run oil through a refinery, gasoline doesn't just come out like fuel oil does or like middle distillates. It's a blended product, and the sort of straight run gasoline part is effectively naphtha. So naphtha is like kind of one of the primary blending components to make up a gasoline blend. So that spread is key.
Well, indeed, I think we want to go into a chart to just see this a bit more clearly, just enlighten us further about gasoline blending.
And I think just as we're looking at this chart, it's really important to say, we frame this with oil prices going down, but there's a lot going on when we looked at the refined barrel. There's heavy fuel oil all the way up to light end gas. They don't always track the outright Brent price that people tend to focus on these days. So, here what we're looking at is a refinery, a simple refinery. That's the sort of like long oblate beige atmospheric distillation unit, crude oil going in, and you get gas coming out, and you get very heavy asphalt. Asphalt's actually a construction product. You're getting tar coming out, bitumen coming out at the bottom end of that. So, basic GCSE, I was going to say O-level, showing my age again, GCSE chemistry, right? And we've got the light ends at the top and the heavier ends coming out, and middle distillates in the middle of jet fuel, diesel oil. But we've got the light straight run and the heavy straight run, which are naphtha priced products. And all of this is blending into, if we're looking at the chart, I don't know if my little laser pointer is going to work here. No, it doesn't work. So we're looking at the gasoline here. And there's the key thing with gasoline, unlike diesel and jet, that have very strict specs. Gasoline does, but there are lots of components that blend in to get gasoline to its environmental and specification. Lots of elements coming in. So you've got naphtha elements and gasoline, FCC elements, hydrotreater and alkylation pieces and isomerization. But it's coming in to build that gasoline. And finally, that last 10%, if the gasoline's coming into this country, is ethanol. Nothing sometimes to do with, but actually bioethanol typically, because this is about greening the network, is coming in, and that price is completely set totally differently. But what we're focusing on is gas naphtha. Why are people thinking about gas naphtha? And that's because the LSR and HSR are priced on naphtha, but I'm blending to gasoline, so I'm buying naphtha related product and selling gasoline. So I need that spread's very important for my economics and margin at the end of the day.
Yeah, because that kind of price is driving the demand and supply and demand, right? It has to be economical for people to want to kind of blend gasoline outside of what they kind of have to do, which is why it's so significant at the moment that it's kind of blown out so much.
Yeah.
What about the timelines then for gasoline blending, and certainly, how exposures evolve?
Okay, so let's maybe deal with the timeline secondly. That's a really good question. But the exposures, this is a good sort of breakdown, isn't it?
Yeah, so this is just like an example slate of a gasoline blend. I would caveat, for viewers at home, don't take this as kind of a perfect blend of gasoline. But like we were saying, you've got your kind of components. You've got 5 components here. I kind of just pick them relatively like random, but they are the key components. So the naphtha, or like as Julian was saying, the LSR and the HSR, which comes from the refinery. So this is the kind of naphtha portion, which is kind of related to this gas naphtha spread. And then you've got components like reformate, alkylate, isomerate. We put ethanol in here just kind of for visual purposes, but like Julian said, it's kind of not always blended initially.
Depends on the local sort of jurisdiction where that gasoline's heading, doesn't it? Yeah.
Yeah, but all of these like blending components are effectively to kind of tweak the spec, right? Is that a right way of saying it?
Absolutely. To make sure it make sure it hits spec. Has it got the right amount of benzene A? Is it not going to knock? Does it have the right RON? All the different spec elements to make sure it does blend there.
Yeah. And it's a real skill, kind of gasoline blending, getting all these right and at the most kind of efficient cost. But
It's almost like baking a cake, isn't it?
But yeah, basically it is. Yeah.
So I've got 3 eggs and my flour
Yeah.
exactly to get my final gasoline.
The recipe.
And actually, I guess what you've done here, Harry, you've assumed you're producing 100 kilobarrels, right? 100,000 barrels of gasoline. So you've got about 40% naphtha.
Yeah.
You've got 25% reformate, which is tends to be based on the gasoline price.
Yeah.
Alkylate about 15%, again gasoline here, and isomerate naphtha based about 10%, and then that ethanol, which is not ethanol from a refiner, but ethanol from biogenerated ethanol, bioethanol that's coming in to greenify the gasoline blend here. If this was coming to the UK, this is the kind of blend you'd expect, right?
Yeah. And I just put some kind of relatively arbitrary terms and pricing periods, just if we want to kind of talk through an example, maybe a bit later on, about kind of how it would all work.
And let's talk too about timelines.
So here we've got a timeline, left to right, that's increasing time. At the top of that blue line, on top of that blue line, we've got a physical exposure coming through. So let's just pretend I'm a potential gasoline blender, and I can see that pricing started to move. I've used Flux markets. I'm looking at gasoline. I'm looking at naphtha. It's widened out. I think the blend's on. I have decided that I'm going to put that play on. The play, that's my physical blend decision. Okay. And I decide to arrange to buy my naphtha, and at the same time, I'm going to sell my gas nap position. So we've got the physical at the top here, the decision on paper hedges, and so I'm going to sell the gasoline swap and buy my naphtha swap. I'm going to sell the gas nap derivative, okay, on Flux markets, okay. Then I actually come in and buy my physical naphtha, and let's just assume it prices on that day. For different people, it prices in different ways. I'm then going to sell that naphtha swap out at that time, or I let it settle depending on how my physical price is. I'm then going to blend in tank. So I bought my physical up here, I'm blending, and I'm going to sell gasoline that I blended from naphtha and those different blend forms, the flour, the eggs, the wheat, whatever, the water that we saw earlier, to make my gasoline blend up, putting it in that cake analogy. I'm going to sell that, so I'm then going to buy my swap back when I sell that out. And that's the process. So I'm putting my gas nap swap on. I'm going to sell that swap. I'm going to buy back. I'm going to sell, my naphtha swap as I buy my naphtha and my blend components, and then finally I'm going to buy back my gasoline swap as I sell my physical blended gasoline out. It's a bit tricky, right?
There's a lot of thinking in there.
Yeah.
That's a lot of moving parts.
Yes.
Yeah, and in the previous example blend that I put up, the reason I used some components pricing in January and the gasoline sale pricing in February was to reflect this kind of time taken to blend, and also to illustrate the risk that the blenders have in that it's not just kind of like a 1 month spread, like interproduct spread. They actually have a kind of time.
Can easily breach that time spread risk, right? As different months.
So you start to introduce like a time spread component as well, where you are sort of buying all your products in, let's say, November, but you're actually selling the finished product in December, which has so you introduce a time spread component, and that's where things like being on top of backwardation and contango really make a difference, because that can kind of eat into or amplify your margin on the deal.
And we're going to look at the gas nap pricing in a second, but the context, let's not forget here, is actually outright prices are dropping. So it's managing this exposure when you're buying and selling things at different times. We really do need to manage this risk, and the Flux markets, gas nap, access, easy speed of getting onto that system, easy transparency so you can monitor when you want to put your blend on is really effective, I think.
Let's neatly then move on from that to what's been happening in gas naps recently.
Well, up until very recently, as we said, there was the big rally. I think the chart that's on the screen now. So this is an Asian gas nap. So this is 92 MOPS. So this is a Singapore gasoline contract versus the Japan naphtha contract, which is the kind of benchmark in Asia for the naphtha pricing. So 92 versus MOPJ, which is the Asian gas nap. So yeah, you can basically see it was kind of since the summer. It's been ticking up, and then kind of blew out in October. When the gas
is dollars per barrel, right?
Yeah, this is dollars per barrel. Yeah, so it kind of peaked around $50 per barrel.
So it doubled, right, from 9.5 all the way up to 16.
Yeah, pretty much.
Almost.
Yeah.
So what was driving that then?
well, just like we said earlier, just everything that was kind of driving.
Refinery outages,
Yeah.
seasonal demand, regulations, and Rosneft and Lukoil sanctions.
Yeah, there was just this huge, enormous move up in the gasoline market, and it kind of just dragged the gas nuts because the naphtha didn't really do too much.
In actual fact, the Lukoil, sorry to talk over you, Harry.
No, it's all right, go.
The UK government, a week before the US announced their sanctions, which are 90-point sanctions. They're 90 different sanctions. The market didn't seem to react. Brent didn't react to that. Brent reacted to US, Trump's. So it's really interesting, isn't it? But you can see the gas naphtha here reacting there, and it was on the 12th. It was on the 12th of October that got announced. So it's really interesting. It starts reacting actually on this. So again, we're here highlighting here, being able to see the whole of the ecosystem of not just Brent and TI, but all the different factions really can drive. Here you want to be long, but you might want to be short Brent, in actual fact.
But on the day, there can be some big
plays.
geopolitical event or tariffs or something knocking about.
Totally different plays, right?
Yeah.
Sorry, just bringing it back to the casual investor that might be looking.
No, absolutely. And then you can kind of see very more recently, you've got this pretty sharp drop off where there's just been like a big correction in gasoline markets in general, like the same we've seen on gas oil. So yeah, the gas naphtha has been probably more indicative of just what's going on in gasoline because naphtha has been fairly stagnant comparatively.
Yes. And this is all from Flux, right?
Yeah, these charts are all from Flux. Yeah. So this is the European gas nap spread. So this is EBOB gasoline versus Northwest Europe naphtha. So yeah, kind of similar price action. And yeah, it's worth mentioning that these are all tradable markets on Flux markets as well.
And this one's dollars per ton, right?
And this is a dollars per ton contract, hence the higher price. So yeah, I mean, it's almost identical price action. You just got a kind of big rally in October and then...
This one's actually almost tripled in value, right? From 50 to 140.
Yeah. Yeah, and kind of seasonally, you know, those sort of winter gas nap spreads, you wouldn't, you know, anything kind of above 100 is quite high historically, right? It's a cheaper spec to make in Europe.
Yeah.
The winter blend is cheaper, right? So that the blending components don't need to be as...
So if I'm a gasoline blender buying cheap LSR and HSR, naphtha priced related products, my play starts opening up, you know, September, October, I'm going to be hedging here, or maybe I wait for my hedge and start hedging up here. But access to Flux markets is giving you a lot more information to time that hedge better. This is the deck gas nap.
Yeah, this is the December contract. Yeah, exactly.
I'm going to look a little bit more detail in some of the price movement detail that you can get from Flux if you're trading on Flux in a second, I think.
Well, quite. Let's delve into hedging flows just now then. Just take us through what we've been seeing, say, in the past month.
Yeah, so yeah, interestingly, there's not been an enormous amount of hedging activity, especially in the prompt months, and that could be just because people were hedging kind of lower. You might have seen in previous months on the first got a big move up, a lot more hedging activity than now. And actually, we have seen hedging for the Q1 months more than prompt. And this isn't hedging flows, but there's been an increase in speculative flows. Where, you know, when levels kind of topped out, there was quite a lot of speculative interest going short these gas nap spreads from kind of physical shops, blenders alike, you know. And we've seen a lot of them kind of buy back on the lower levels, which is kind of what gave us the hint that they were kind of just speculating short. Maybe they didn't have the physical barrels to blend behind it, and they just wanted to sort of take a punt. But yeah, nothing too crazy on the sell side on the move up, but yeah.
So what we've also seen, you know, if we look into the secret source of Flux markets and the data generated by the group, here we have commitment of traders. So COT, we refer to this as commitment traders. It's our proprietary data. So just so everyone understands, real time, the company is trading and recording the generic industries of people trading and the direction on all the different derivatives. And you can get access to this data. And we're actually looking here, not at the gas nap December, but we're looking at the east-west. That is Asian versus European naphtha. Okay, and this is the COT data because actually we've seen some really interesting moves here. And what we've got on this slide, if you go into Flux Markets and you're trading on this system, you can get access to the data. First thing to point out, where that blue arrow is pointing, we start seeing some extreme length, so some danger levels. And you can get these alerts flashing up on the screen if you're subscribed. So straight away, there's something going on here. The next thing is we've already seen prices that we were looking at just now, and this is the East-West NAFTA, but it's all kind of related. We see some price movement here, and we get the net short positioning and the net long positioning. And if we move to the next slide, the real key data here on the next slide. So we saw this price move up here, and it looks like everything's over. But then suddenly here, sort of like towards the end of October, the sanctions start biting and some refinery turnarounds occur. We see the refineries are no longer going net short, they're closing out those positions and going long, suggesting they're not producing as much gasoline, okay? And we're seeing this data coming through here and this change here. That is an early warning flag you can't get anywhere else. The market doesn't move at all, but then suddenly it goes off the chart again. It starts really rallying up quite substantially. $5, $6, $7 a barrel here. So this is an early warning chart. And this is really interesting if you're a gasoline blender, physical blender, thinking about putting a play on. Would be a great time to put a play on as that was developing. If you're involved in the NAFTA market at all, or if indeed you're an investor, financial investor, whether you're a fund or a private individual, this
you need
is really
info
interesting.
like
This is info that's
Yeah.
critical to decision making.
Fantastic. Key stuff. Right, specifically then, how can Flux Markets help gasoline blenders manage risk?
Yeah, well, I think the most important thing to say is that Onyx as a group has a very dominant market position on the financial contracts for all this stuff. We've got like years and years of expertise that we can help clients kind of structure hedges, work out their physical exposures. I mean, before I came to the meeting, was working with a Dubai-based client, going through like a blend that they're putting together and how they want to hedge it. And we help them kind of construct the hedge, make sure everything matches and make sure they're happy with everything. But yeah, kind of on a market share basis, so Onyx trading, so they can be up to 95% of market share on a given day of gas nap contracts, between European and Asian. So yeah, we're very heavily involved in all aspects of it. On the Flux Markets platform, we have all the contracts that they can trade. Again, they're effectively trading with guys who are taking the other side of 95% of the market sometimes. So yeah, deep liquidity. Yeah, it's the best pricing. Low execution cost, and full transparency.
And the only other thing I'd add to that, because I think that's a really good low execution cost, kind of encapsulates that, but actually very low initial margins. The deposit you need to trade on Flux Markets is half that of sort of the equivalent contracts on other exchanges. That's really, you get double your bang for your buck, essentially, right? That's important.
So much expertise and data on offer, clearly. Would you sum it up by perhaps saying 9 times out of 10 the client will take your
absolutely
data and what you advise?
Yeah, absolutely. Yeah. I mean, that's what we're here for. People come to us because they want to hedge and they want to feel comfortable that they're in good hands. And yeah, that's exactly what we're here for.
Yeah, indeed. And actual fact, I mean, we've got some hard data points on that. Petronas did a training course with the learning and development team run by James Rody, brilliant guy. And they rated that 4.9 out of 5, which is incredibly high. And when I read that and saw that, I was thinking, wow, these guys have been trading for years. But so this is it's the company's great at training and socializing and making it accessible. And I think that's apparent in Flux Markets.
Good to hear. Harry, Julian, thank you very much indeed. And that's it for this week's session of The Hedging Show. Thank you too, of course, for watching. And remember, you can head off to flux.live or freemium or the QR code, which will be on your screen, for much more info. We will see you next week.
Hi, welcome to Trading Corner. I'm joined with Raj this week. Raghav's in sunny Thailand, lucky him. So yeah, we're just going to jump straight in. I think the main thing to really talk about this week is the margin. We've had a decent pullback. If I just show you this curve here, you know, we hit highs kind of, well, about a week, 10 days ago, highs of all year, and we've pulled back significantly. So I'd love to get your input on the middle distillate part of the curve, but some of it's also been attributed to crude. You know, we've rallied quite a decent amount now in DEC DFL, Jan DFL, which is all contributing to a weakening margin. But also, you know, the light products, they've also come off quite a lot. I think just speaking with Raghav over the last couple of weeks, there's been fairly consistent gas snap selling. I think the flavour of the last few days has been a lot of naphtha selling. So more compression on like the tails of the margin. So yeah, it's just the middle distillates has been the main story of the year. The relentless strength, you know, we had the lack of the draws over the summer, we're going into winter and we've finally got this cold weather. Is the market, I mean, I think I know what you're going to say, but this is where you'd expect the gas oil stocks to be drawing and actually the crack starting to hold up. Absolutely. How is it playing out?
I think if anything, we've seen a clearly very exaggerated effect on the gas oil part of the margin curve. But so far, really, the big spike in the sell-off is probably more related to the sanctions and the Russia-Ukraine story. So starting off with last week, why we saw the spike was arguably just tighter ICE guidance on what they were going to do with regards to accepting any cargoes for their assessment from other countries. So far, the European sanctions have been taken a little bit lightly and maybe the enforcement has been a bit lax. But this time around, ICE have basically given us very strict guidance on what they will allow into the assessment process for gas oil.
This is important for just expiry or for every window?
This is for every window. This is gas oil in general.
Okay, so yeah, exactly. You know, you have contracts, swap contracts that's priced against the paper contracts, but also the physical cargoes. So if you're limiting the amount of physical cargoes that can go into the window, of course we're going to rally, right? It does make sense. Exactly. So now we've sold off of it. Is that because, you know, perhaps ICE are having a bit of, you know, pushback on which cargoes are allowed in, or is it purely speculation on the political stuff?
Nothing has changed from ICE's end so far. If anything, maybe the sell-off started to ease a bit once some of the shots had been squeezed out. But a large bulk of the sell-off is probably attributed to Trump's comments about Russia-Ukraine potentially easing.
Yeah.
And even though the odds on that aren't really spiking at the moment, and there's been a little bit of pushback from the EU and Zelensky on this, what we're seeing is perhaps a sentiment-led sell-off. Nothing has changed on the assessment end, so we still have very tight guidance from ICE on what will be classified as a Russian-derived fuel product or a gas oil product. So yeah, it's mostly sentiment-driven, I'd say.
Wow, it's a bit crazy, isn't it? I mean, it's definitely worth talking about this. Trump, I think it was the 28-point plan or agreement that they released last week. It's very, you know, not to get too political, but it's an aggressive agreement, and I think everyone's just in a tight spot where, you know, it could very well be agreed. I don't think just because of its aggressiveness that we should totally rule out the fact that we're going to come to an agreement. As you're saying, like all of the you know, the feelers in the market, people aren't expecting Ukraine to sign this deal, but it's getting to a point where they are feeling quite exhausted. So perhaps there'll be some amendments to make, etc. But either way, it does, you know, the last 3-4 months, it has felt as though this is all starting to draw to an end. And that's going to be massive for the oil markets. You know, if we do get all this crude coming out, all this LNG, a lot of, you know, gas, all the products, everything, you know, obviously the refineries will take some time to come back online. So it's mainly the feedstocks, crude especially, it's going to hit the market hard.
Absolutely.
So yeah, it'll be super interesting. But yeah, just just on the back of that, also, we're going into a period of, potentially lower liquidity with Thanksgiving coming up. There typically tends to be some kind of funky price action when the market's out. So let's see into this week. I think you just have to be a little bit cautious that with that lower liquidity, there might be some aggressive price actions. Okay, interesting. So gas oil giving up a little bit. I mean, let's see. The market might buy into it. We are drawing stocks, right?
Yes.
So the underlying market is still fundamentally very strong. It's just a potentially repositioning.
Yes, absolutely. But I guess the overall levels themselves can't be ignored. We're still very, very high on a crack basis on distillates. The US still remains strong. There should be strong seasonal demand around this time of year.
Yeah.
So there is strength in the market, but perhaps it's just been exacerbated by the headlines.
Exactly. And also, you look at any chart like this, this sell-off looks crazy. It's huge. But we have come off from $14 margins, which are enormous, to still almost $10. Still very profitable for refiners. Still, the cracks are very strong. So even though we have given up a lot, there's still a lot to go before you see any material change to the run rates. So I don't think that's obviously going to happen anytime soon. But crude could be a slightly different picture. We came from a max bearish environment on the prompt crude cargoes to now a very strong forward curve. So we need to see a lot of physical demands coming out this week and next week in order to hit the forward curve levels, which I'm a bit skeptical about. There were rumours that a lot of the oil that was eventually cleared was put into storage. So we might see that re-entering the market this week or next week. But to go from diffs of minus 150 on 40s to plus 60 cents in the span of 10 days, I think it's going to be hard. So let's see. It feels like potentially we're going to start topping out on crude in dated, at the least at the minute. Okay, so that's Europe. I mean, it doesn't look like anything too interesting. Obviously, we've had the margin pullback, crude strengthening. Potentially will give up some of that crude strength in the next week or so. Asia, how's Asia looking for you guys?
On the distillate side, it's mainly been a Europe-led rally. We've had some pockets of demand from Asia, but really most of the moves have been just on the back of ICE gas oil.
Okay.
So we've had the spread strengthen with ICE gas oil and then sells right back off with ICE gas oil.
And how about the East-West?
That's the one thing I'd say has become a little bit decoupled from the price action that we've seen so far. Because what we've seen has been the cracks absolutely ripping and then selling straight back off. But the East-West still remains a little bit suppressed. Arguably, this is down to the physical flows, since a lot of gas oil produced in Asia might not make it into Europe as a result of these sanctions. It just means there's going to be a bigger backlog of cargoes in Asia having to remain either in the region or being pushed into LATAM. So what we're seeing is East-West at very low levels. So, even things like the East-West boxes, the 1-2 East-West box, it reached historical lows of 11.5. That is minus 11.5, which is, Russia-Ukraine levels, at the start of the war. So we're just seeing a very, very suppressed complex as a result of potentially more cargoes being stuck in the region.
Wow, interesting. So I guess the next big event into, you're talking about Q1, Q2, into the new year will be Chinese New Year. So perhaps that might bring back a little bit of product strength if refineries start to potentially pull back on their run rates or something. But yeah, that is low. Wow.
Yeah.
Okay. So, I mean, the freight rates are still fairly chunky. So you kind of do understand why those East-West do end up softening a bit. But for us, for Brent to buy, I mean, the curve is just totally paralyzed. So very little price action. It looks like it is the most stable curve at the minute. The dated Dubai contracts are more volatile than the Brent Dubai contracts. So it is really suggesting that the East is not too fast to position here.
Yeah.
And then you have the US. So into Thanksgiving, arguably, the liquidity will drop off. Perhaps we'll get less interest in kind of cargo fixing, etc. But the curve also, relative to Brent, still looks fairly low. So Brent is really, at a strong premium to all other regions. No real reason why. So I think we'll probably start compressing in those kind of geographical arb levels. But again, if everything gets resolved, we should see freight get hit, we should see crude get hit. I think the environment, could get quite crazy. So yeah, it just needs to be aware of it. The only other thing I wanted to point out is, again, we get all these headlines, etc. Russia, Ukraine, all the sanctions, it was meant to hit, I think Thursday was the deadline. Still, flat price is fairly low. The front Brent spread is pretty strong, actually. I think it got up to around 63 cents. We have expiry on Friday, so let's see who's looking to buy the cargoes there. But given that potentially a lot of oil is offline, flat price looks low, which means that the market doesn't really think that the sanctions are going to hit as hard as the market has suggested. But let's see. I think there's still a bit of time to kind of get around the logistics. Okay, so I guess, as I said, we're going into Thanksgiving and then Christmas season, so it's probably quite difficult to put on any meaningful trade. But if you had to suggest something, what would you go for?
Probably on balance, the one position I'd look to kind of put on would be slightly more deferred. If I had to pick something, maybe around the Q2, Q3 region, maybe some longs on the gas oil East West, simply because the prompt has been, pushed to such distressed low levels.
Yeah.
It might provide a good entry on the deferred East West, and potentially might even, provide a little bit of time for things like Russia, Ukraine to get resolved, which then would lead to the East West really ripping in that kind of region.
Yeah. So what levels are they at right now?
So right now around minus 22, minus 21 on the 2Q gas oil East West, for example.
Okay, so still great at entry levels.
It is still a great entry level. You could see, if Russia, Ukraine gets resolved, we're talking about, single digit East West numbers. So quite a lot of upside there.
Okay, great. And for me, so last week we went long TechGen dated. So I'd look to exit that now. I think it's had its run up. And a little bit more niche, I think I would go for either a short dated Dubai contract or a short structure index. So something like 812 2-week I would short, or 812 Caldex. Very specific to dated, but generally, if you short a structure like that, you're suggesting that perhaps the physicals reached towards the higher end of the level. Cool. Well, let's see how we are in a week's time. Thank you.
Well, hello and welcome to another episode of Flux Insights. I'm Lisa Aziz, your host for today's exciting show. And joining me for this episode are key members of Flux's research team, Research Associate Peter Chaturvedi and Quantitative Research Associate Harinder Sandhu. Hello, guys. Good to see you. Hello. Just remind everyone what it is you actually do.
Thank you for that introduction, Lisa. So I'm a Quantitative Research Associate here at Flux. My work mainly revolves around unpacking proprietary data, the COT data that our traders produce from our market making activities, leveraging that data to produce insights, to highlight where the market might be positioned long or short, and to derive ideas off the back of that.
Thank you. Thank you for that introduction, Lisa. My name is Meeta Chaturvedi, and I am a research associate at Flux's research team. So I work with Harinder. I work on the more traditional side of the research, and we look at, as Harinder mentioned, we look at Flux's proprietary positioning data that we get from our traders, and we use that to find emerging insights into new trends surfacing that in the crude oil and refined products.
Hugely valuable info.
Definitely. So these insights include positioning insights and trade ideas that we present in weekly, monthly, daily reports alongside in shows such as this one. So very exciting.
Fantastic.
Yeah.
All right, let me tell our audience a little bit more, though, about what Flux Insights actually is and what you're going to learn in today's programme with Harinder and Meeta. So each week, our valuable research team will dissect the latest trends shaping the oil market, which, as we all know, influences everything from geopolitical events, conflicts, inflation, right along to how much our energy bills could increase by or not this wintertime, and how much we might end up paying at the petrol station, you know, when you want to fill up your car ahead of the weekend trip out. So with Flux's proprietary financial positioning data, we deliver a view of the oil market that you just won't find anywhere else. We're at the forefront of early trend shifts and can convert them into practical, actionable opportunities. So in the next 30 minutes or so, we're going to cover recent happenings in the market, followed by a positioning review, a deep dive into an interesting swap contract, technical analysis of the oil market, and a trade idea for the week. Lots to get into then. So with that in mind, Harinder, firstly, what's been the big mover in crude oil this week? Take us through it.
Absolutely, Lisa. So it's all been about the Ukraine-Russia situation. So this week, actually, towards the midpoint of last week on Wednesday, we had a leaked draft of a 28-point plan, post-ceasefire plan between Ukraine and Russia. And that was, in principle, agreed to. A statement from Ukrainian official spokesperson. They're agreeing in large part to the terms of that 28-point agreement that came out on Tuesday. So it's very positive towards a ceasefire and potentially bringing Russian oil back online. But it's very nuanced. There's a lot of steps left to overcome. Russia, in particular, the Kremlin has issued a statement saying it's premature to consider this deal complete. It's a number of stages left. And this comes after on the 21st of November, where sanctions were fully implemented on Rosneft and Lukoil, the two large Russian oil majors. And as part of that 28-point agreement, there is a gradual phasing out of those sanctions, but it needs to be underscored that will come should the ceasefire maintain, should Russia hold its side. So it's not quite as simple as Russian flow will immediately come back online. It's going to be a very measured approach that the two countries will take.
Enough, though, to make traders, refineries, freight people nervous or not?
I think definitely. I think a really interesting point to note is the Nayara, the Indian refinery, has actually continued persisting in its utilization of Russian crude in spite of sanctions. So in August, when original sanctions were in place, then the output dropped about 400,000 barrels per day to about 240,000 barrels per day. But since then, it's rebounded back up to 400,000. So it kind of underscores the point that even though these sanctions are in place, there's still, to some extent, some transgression of those sanctions. India continues to be piling into Russian crude. And it also underscores a further point that even though Russia, in principle, will produce more crude or allow more crude to circulate, really it could just be a displacement of crude as opposed to new crude coming online. So crude might end up just moving between different areas.
Definitely. Just to add to that, I completely agree with the fact that this is so nuanced. I think the headline alone would be the headline of a ceasefire agreement would be bearish enough to send oil prices down for a bit. But I agree, the situation regarding sanctions is so much more nuanced than that. As for Indian refiners, so Nayara is partly Russian owned and they've continued their intake of Russian oil. But just on a wider what's happening within Indian refiners. So most Indian refiners, for example, the Mangalore Refinery and Petrochemicals, Hindustan Petroleum, and HPCL Mittal Energy have stopped buying Russian energy altogether, Russian oil altogether, sorry. Reliance, which is a really big refinery in India as well, they've loaded cargoes pre-committed from October 22nd. So that was the day of the sanctions on Lukoil and Rosneft, if you remember. And they will process these at their refinery, even if they come after November 22nd, which makes sense because they say they abide by sanctions, and they do. These were committed to before the sanctions on Lukoil and Rosneft. However, interestingly, Kepler data recently showed that India's November Russian oil generally is set to reach its highest level in 5 months. This was because they were essentially preloading a lot of their cargoes ahead of the sanctions. So in just numbers, India's purchases of Russian oil are expected to rise to 1.85 million barrels per day this month from 1.48 in the previous month. So this defies numerous predictions of an immediate drop in Indian buying of Russian oil. But again, so these purchases would be the highest since July, but imports are seen falling to their lowest level in 3 years, at least in December. So this rise that we've seen in November could just be a spike, just like front loading ahead of those sanctions, ahead of the US's deadline of the sanctions on Lukoil and Rosneft. So I think it'll be more interesting to see what happens December onwards, especially with these major refiners, Reliance, HPCL, Mittal, etc., agreeing to stop buying Russian oil.
All right, thanks for that. Harinder, let's just move on now, if we may, to refined products. What's the latest with, refinery margins?
Absolutely, yeah. So this week we've seen a big retracement in refinery margins. They've been quite elevated for some time. We've seen them come down, particularly the European refinery margin index, which I have on my screen here, showcases a significant fall. I mean, we've seen it falling basically day on day, down to levels around $11.43. Mm-hmm. I think this is really underscored by movements in all the product cracks. So all the products have seen weakness, leading to the refinery margin falling. I think there's also a really interesting headline previous week with ICE, the exchange, effectively restricting the deliverable grades of diesel, which basically meant that at that time, potentially Russian diesel or any crude produced or any crude passed through a refinery from Russian origin would be prohibited to be declared into that physical contract. Into that contract. So what that would mean is effectively, for that period of time, the gas oil supply potentially could have been tightened, exactly, which led to prices rising on short players.
It essentially cast like a wider net on what is sanctioned, essentially. So that would essentially lead to like short-term tightness. Is that what you mean?
Yeah, exactly. So in the short term, there were short stop outs, as basically the market might have thought there'd been restricted supply. But that was a very sort of transient period of time. And now in the last few days, we've seen it retrace back down the refinery margin. So that's basically been the big thing in margins this week. And what do you think you could further contribute to this meter? Is there anything in the data?
That's interesting. Yeah, I completely agree with what you've said, Harinder. But adding to this, in physical crude, in the dated Brent market, the physical differential has risen from around $0 per barrel last week to around 71 cents, just above 70 cents this week. So that's a significant increase. And a lot of this strength has been concentrated in December. So that's fairly prompt. We've seen in the physical market, trade houses bidding up the physical. We saw bids in WTI Midland and 40s yesterday. However, there seems to be little fundamental backing for this support, this significant support that we've seen this week. I think this could very well be continuing in the prompt. So it'll be interesting to see how that impacts margins. So just for our viewers, an increase in dated Brent, that's crude. So that would definitely weaken margins because crude being the cost for refiners. But just on the product side as well, just to carry on from what Harinder said, this gas oil weakness that we've seen this week has supported the gas oil East-West. The gas oil East-West being Asian gas oil, Singaporean gas oil versus European gas oil. So if you look at my next chart over here, this increase this week has primarily been because of weakness in European gas oil, despite Asian gas oil also being weaker. However, we have seen sell-side interest in the East-West, which isn't common. So the usual flow for gas oil is from the East to Europe. So you would expect them to buy the East-West instead. You would expect refiners to buy the East-West instead, but that's not really happened. So
any particular reason they're the drivers of that, or something geopolitically happening there?
Not sure, honestly. It could just mean that there is perhaps it could just indicate that there isn't as much flow from the east to the west. It could be Indian demand increasing. It usually does. And I mean, November, we had Diwali, for example, right now in India. That tends to see diesel demand increase. I'm not sure about, so this would be for like December into Jan. There could be some reason to believe that India would still need its diesel. But I'm not sure. But in terms of other suppliers of diesel, China, there's some news out of China. So for China, their diesel exports are expected to increase to 4.5 million barrels in December, according to different sources. I think this was a source of Reuters that mentioned this. And refiners, a lot of this is because refiners are probably taking advantage of these high margins that we've enjoyed. Even though margins have declined this past week, they remain at fairly high levels historically. So that's something a lot of them might want to capitalize on. Interestingly for China is that their crude allocations were also up year on year in Q4 of this year. And recently we've had data that their import quotas for non-state refiners have increased year on year. So there seems to be crude buying appetite coming out of China. And a lot of this could feed into, refiners buying crude, more product exports. So, because the crude oil, a lot of product exports towards the end of this year were constrained by fewer quotas. So having these quotas increase next year, it just gives me more of an indication that China might want to export more. There is some crude buying appetite out of there.
All right, Mita. Well, while we're talking about refined products, we have spoken, haven't we, about gasoline cracks of late and how the strength in them may begin indeed to crack. Tell us a little bit more about those and how they look this week.
Yes. So if you see my chart over here, we did mention last week that we're starting to see cracks in the RBOB crack, and we did see that materialize. So you see that. So this past week has seen more weakness in gasoline. It seems like a lot of the market had started. I assume a lot of this is taking profit. Plus, last week we saw AI stats print a build in in US gasoline, and that led to some selling in RBOB, and that probably made a lot of the market really antsy and just really keen to take profits, which exacerbated this move down. Interestingly, this week we've had another build in US gasoline. However, if you look at my next chart over here, this is data from the EIA, just over here. So US gasoline stocks, if you look at every chart except for that second one over there, have been rising, except in PAD 1, where we saw a drop. PAD 1, that is the New York harbor, is very important for gasoline because the US imports a lot of its gasoline, and this lands in the New York harbor. And the fact that it's declining, it's near historical lows, and this is also Thanksgiving week, we should see demand rising this week, has been fairly supportive of RBOB, which is why we've seen prices find a floor around here. I don't know if this is going to continue, but we have seen bids. The ARA barges in Europe have remain fairly high. There could be some short-term tightness continuing to support the gasoline market.
Do you go along with that?
Yeah, definitely. I think the point Mita raised about Thanksgiving makes complete sense. Of course, you might expect it to be a bit more supported here. RBOB has come off. I think, like you said, if this is a floor, it might remain for a little bit longer, but there's always a possibility it breaks a little bit lower.
Yeah, I think, for sure. We are definitely at higher levels for winter gasoline, but we do have reason to believe just fundamentally that there could be some tightness here. So wait and watch, I guess.
And we're going to look at fuel oil too?
Yes. So if you look at my next chart over here, this is something we've not spoken about before, but recently at least. But this is the Rotterdam, the Northwestern European high sulfur fuel oil crack. So this is heavier part of the barrel, and we've seen significant weakness in 3.5 barges recently. And this is interesting because the first half of this year, 3.5 bar, high sulfur fuel oil generally was really strong. It soared to seasonal highs, historical highs. And so this weakness recently has been a product of oversupply. We've had good production out of the Mediterranean. Europe's been fairly well supplied. The run spread had fallen below zero. So that's just indicative of a pretty well supplied market. However, we're starting to see some consolidation over here. More on that later. We'll talk about that later.
All right. Thanks very much indeed for that, Mita. Harinder, let's just move on, if we may, and talk a little more about the futures market. Have there been any interesting changes in positioning, in particular recently?
Yeah, so recently the US government has finally come out of its prolonged shutdown. So that meant that we've had this new CFTC data. Again, it's a lag data, so it's not going to be particularly as interesting as potentially our CTA. But it does show that we've seen in the product futures middle distillates, so gas oil, but also in RBOB, we've seen positioning reduce slightly, pull back a little bit, as potentially as players come in to take off their positioning towards the end of the year. Again, that's less timely data. It's really the CTAs that will be a bit more interesting.
All right. Well, we know, of course, that COT data is lagged by a week, as we tell our lovely viewers every week. Does that mean then that Flux's timelier positioning data is crucial?
Absolutely. So this is where the CTA model, our in-house model, which gives us effectively daily updates on the product futures, comes in really, really powerful. So again, in that time where we've seen that shutdown, we've been able to glean insights into the various product futures, and we can see that finally, the two distillate contracts, so those would be the two gas oil and heating oil contracts, have finally started to come off from overpositioned. What this actually means in terms of sort of for the market is that if the products are finally starting to retrace out of overpositioned territory, there's possibility for them to continue, and there's a lot of room for them to continue to the downside. And it's the first time that they finally emerged from this overpositioned level since, I think it was the 27th of October.
And completely aligned there.
Exactly. This just goes to underscore the strength, particularly in gas oil that we've seen, the cracks were at basically all-time high levels. Finally, those are starting to come off, which indicates, again, that there might be some further room to the downside in that complex. I think this, again, it underscores the point that even though that they have been, in the past you've seen as well, they've been elevated, there is this tendency as they come off for them to revert to neutrality. And so we might see a similar trend happen in the coming few days and potentially weeks. Right. De-risking as well could contribute to that further, leading to gas oil and heating oil to revert back and prices to drop further.
Any significance that we're now literally right at the end of the year as well?
I think so. I think because, of course, this is a model that effectively looks at the level of positioning. You would, of course, expect everything to kind of revert towards neutrality, but generally as players are risk off, the positioning index should tend to move towards neutral. And it is what you're seeing. Like you're seeing gas oil and heating oil come off, you're seeing RBOB sort of revert back. The other indices, other Brent and WTI are also outside of underpositioned levels that we've seen before. So it does go to show they're kind of all compressing. Every single one of the futures are outside of overpositioned or underpositioned, which we couldn't say for this period of time. You've always had something at an extreme. So finally, we're kind of maybe converging into a more neutral territory.
All right, let's shift focus now then to the oil swaps market and Flux's very own commitment of traders data. Has there been a recent contract, that's particularly stood out this week, Mita?
Yes, there has been. So we're going to talk about the naphtha market. We touched a bit about this on this last week. Harinder mentioned how high the naphtha East-West has been, and we're going to talk about that again. So that white line that you see is this current year's prices. So the front month naphtha East-West has soared above levels we have seen over the past 5 years. It's above $45. Like that we last saw, and that's a significantly high level. So this is the difference between MOPJ, Flat Japan naphtha, and Northwest European naphtha. And a lot of this is interesting because NWE naphtha, Northwest European naphtha, is fairly weak, while MOPJ continues to see good buying. There's good buying in the physical, there's good buying during MOC assessments, and MOPJ is generally in our data as well seen trade house buying. And while trade houses have been selling Northwest European cracks. So, however, just concentrating on now we look at the January naphtha East-West data. If you look at my next chart over here. So, as Harinder mentioned, we saw refiners unwinding their positions last week, and that's still the case. But just looking at trade houses as well. So we initially saw them trimming their positions before adding to shorts again. They've been selling both the DEC and the Jan naphtha East-West, which is fairly interesting to me because these players are very much out of the money right now. But the market is saturated long and open interest is very high right now. It's well above 5-year highs, which leaves the rest of the long market exposed to a bearish catalyst. Moreover, refiners, I expect, should start selling at these levels. They want to lock in these really high levels. And so I do see some downside from this particular level because of that. That said, refiners, as I mentioned, trade houses have been buying MOPJ cracks in January, but they're selling European naphtha cracks. Open interest in Jan MOPJ is just 6% below the five-year high, which again, the market is so oversaturated. And as we know this past year, things have been fairly uncertain in terms of geopolitics. If we see a ceasefire, that essentially leads a lot more naphtha available for supply. That could lead to some weakness in the east. But it'll be interesting to see. The positioning data is very clear that there is good buying in Eastern naphtha, but there are sell-side flow in the east-west, which contradict that. So that'll be interesting to see.
All right, let's take a break then from positioning data. Should we dive into another interesting way of analysing the market through the means of technical analysis, which I know you guys are so good at, because it uses statistical trends gathered from past data to derive insights from the market. Harinder, just talk us through any interesting shifts in the market, technically speaking.
Absolutely. So I think the first contract that's been super interesting to watch has been Brent. So if we take a look at the chart on my screen here, we see this downward channel that Brent is trading in. So it's actually quite satisfying to see that it tends to move in this downward channel pattern. This upper line basically represents the resistance, and that corresponds roughly to about the 50-day moving average line. We also see the 10-day moving average on the screen there that also has been acting as a resistance over recent times. The RSI, which is a measure of effectively how many consecutive gain or loss days that the contract has seen, is hovering around neutral territory. I think there's further room to the downside. Generally, given that the upper channel has been acting as resistance and it's continuing to trend, the prices continue to trend downwards, there may be further room to the downside, especially if we continue to test the sort of 10-day moving average. I think definitely, technically speaking, maybe a little bit more bearish. Anything you wanted to add there as well, Mita?
I think with the RSI, I definitely agree that does not look good, but I think it's more telling to me that it's been fairly stagnant. We do see this medium-term downward channel, and I completely agree with her in that blue line over there is a pretty good level of resistance. I think from what I last checked was that upper channel line is fairly in line with the 50-day moving average we've been talking about a lot at the past few weeks. So that just adds to its significance as more like not longer term, but just the next level of resistance after this 10-day moving average. I also do see downside from here, but the RSI being that basically sideways tells me that the market is essentially lacking some directional consensus, that everyone's sort of waiting to see what's the next catalyst to get them out of this, either up or down, basically.
Yeah, indeed. The drivers behind could change.
Just looking at gas oil as well after this. So if you could go to the next, so if you look at my chart here, so we've mentioned this particular chart before. So the pink lines in the first panel, that's retracement lines from 2022's high to 2023's low. So these, if you look at previous highs and previous lows and then look at particular percentages of retracement from them, those can be significant levels of support and resistance for a lot of people looking at technical analysis. So these particular percentages, you'll recognize them as Fibonacci numbers, which is why they're called Fibonacci retracement lines. So we're currently, this past week's selling has broken past recent Fibonacci retracement supports and moving average supports. We've gone below the 10-day moving average, which is the first orange line there, the yellow line, 30-day moving average, and we're currently starting to see support on the 100-day moving average. So we mentioned this in our technical analysis report as well this week, that we might see the first line of support over there with further support at around $20, which is like a good psychologically, like it's a round number. The market likes nice round numbers as a cushion. So that's something, I think the purple line over there is the first thing everyone should be looking at that could give us some support, especially with just fundamentally, we are still fairly tight in gas oil. But again, a break below this could also happen, because if you look at the third panel over there, that MACD histogram is continuing to widen in the negative territory, and it's very well negative. So that shows that the blue line right above it, that's the faster exponential moving average, that's significantly widening compared to its slower moving average, compared to the slower moving average. That just tells us that in just short-term momentum is getting more negative than long-term momentum. It's a sell signal for the market. The RSI is at 39. 39 is, below 30 is oversold. So the market, there is still room for prices to go south from here. So do keep an eye on that purple line. I think that is of significance there, because if you see just mid-October, it also held prices and then prices bounced off of that. So yeah, I think that's a fairly important level of support here.
Right, take us through your trade idea.
Yes. So our trade idea for this week is actually in the heavier side of the barrels. So we're going to look at high sulfur fuel oil. High sulfur fuel oil, as I mentioned earlier, has been fairly weak. We've seen good. We've seen persistent supply coming in from the Mediterranean. However, we've seen recent consolidation. The front crack fell below -$8 this week and saw support over there. That's a fairly low level for this year. And we now see trade houses trimming the Q126 crack, which again indicates that we might see some profit taking at this low level, which could support the crack in the short term. So just as a caveat, we do see some the momentum indicators are still fairly on the sell side. If you look at my next chart over here, so momentum indicators, the MACD line on that third panel still shows the MACD line the MACD histogram in the red, but it is narrowing this week, which tells me that negative momentum is waning. And the RSI is also picking up. It's significant that it's picking up from that level because it's bounced off the oversold territory and it's picking up, which again could be a buy side indicator there. Again, those blue lines that you see around price, that's the Bollinger Band. And the fact that price is bounced above the lower Bollinger Band again tells me that this could be a good level of support. And that's that because sentiment has been so weak recently. I would suggest anyone with this trade idea, I would say that target your entry level above that orange line or above the more solid orange line, over there. That's the 10-day moving average and it's been a significant level of resistance. So definitely think you should, I would suggest using that, a close above that to enter this trade.
Harinder, you got
yeah,
with that?
I completely agree with Mita. I think this is a super interesting setup. The fact that we're technically sort of the RSI has bounced off that 30 level, there's a lot of room potentially for the contract to retrace. I think in general we've seen a good bit of volatility around here as well. So potentially there's some consolidation that could happen before we see that breakout.
Definitely.
I think the suggestion to put the entry a little bit higher makes a lot of sense because you effectively by doing that you would eliminate any possibility of consolidation and then moving further down. If somebody were to try to enter at this level where it's a little bit still uncertain.
Yeah, they could see a whipsaw instead, which just means that the market goes against their view. I would suggest that let the market gather its thoughts, let it consolidate a bit, move above that level and then buy.
So that acts as a signal to the buy side for a market player. So I think that the setup is really nice there as well. So definitely agreeing with Mita on this one.
Right, let me put you both on the spot now because it's that time of week. It's our crystal ball prediction moment. Where do you see Brent going then in the coming week?
I think a lot hinges on this ceasefire news. I think the market is fairly risk off because of that. We've had the sanctions and we've weakened a little bit. It just seems like the market is driving for a direction here. What do you think, Harinder?
Yeah, I definitely agree. I think because there's so much nuance to the whole Ukraine-Russia agreement. And I think that because reality is the market's aware that Russian crude is still flowing into India, it's still flowing into various regions, whether there's actually a tangible increase in the crude that comes online or whether it's literally just a case of displacement of the ghost fleet, of the shadow fleet flows, it really remains to be seen whether or not that actually translates to more crude into a bearish narrative. Russia needs to sign the agreement. There's also OPEC to consider. So there's a number of factors.
I do think I am cautiously bullish this week. I do think that just this week alone, we're not going to have a ceasefire this week. I think there's going to be, as you've said, just so many more nuances. I think that it's going to take them a little more time than just this week alone. So I do think we're going to see some retracement up. And then I guess the rest of it depends on what happens with the ceasefire.
Definitely. I think one more thing I'll add, I think that I remember from the gas oil chart, given how much volatility that's seen over the past few days, I think there's definitely room for a little bit of consolidation. The market's going to be risk off, the positioning is unwinding, sort of reverting back to neutral levels. I think there's definitely a case for some consolidation before a really big move in direction. And that kind of coincides with when Russia may actually step forward and decide to sign that agreement.
Well, you raise such a good point because the bottom line is none of this is going to happen overnight.
No.
So people still have to fix their positions and, it's your crystal ball moment, isn't it? See what happens. Exactly.
See what happens, yeah.
All right. Thanks, guys. That is it for this week's Flux Insight Show. I hope you've enjoyed it and learned a lot. I certainly have. Huge thanks, of course, to our fabulous research team, Mita and Harinder. We will see you next week. And remember, for a deeper dive into our research and data offerings, you just need to go to flux.live, and feel free also to reach out to us with any questions and comments on the website. See you all next week.
It's been an incredibly crazy ride in distillates this year. Diesel, jet fuel, all over the place. Some people banking their entire years on being short, then the reverse, then back and forth again. And we've had so much going on, be it sanctions, weather, just general positioning against gasoline, all that kind of stuff. So we thought we'd take a deep dive into this, go through the scenarios, what's been driving it. I'm here with Mita to discuss. So Mita, why don't you get going?
So thank you for this opportunity to talk about gas oil. Gas oil, the too long didn't read of the podcast, is that gas oil has suffered from, we've seen a tightness in supply that nobody saw coming at the start of the year.
Yeah.
And that's taken prices. This is the frontman gas oil crack. That's taken.
Just quickly, so yes, this is the blue line, right?
The white line is 2025.
Yeah.
The blue line being 2022, which is the last time we saw.
So if you go right to the beginning.
Yes.
Can we go across a bit? No.
No.
So basically, at least from my memory, so we started the beginning of the year more like 20-ish, and there was a general consensus that distillates would normalize. It's actually still, I guess, the echoes of 2022 still in the distillate market. And we know there was one particular trade house who had an enormous short position. I think some people were coattailing on the back of that as well.
Yep.
Generally a short spread position, but on retrospect, nothing really more to it other than kind of mean reverting to normal. And that's how we started the year, I would say.
Definitely. So just on the fundamental side, demand people were bearish demand for gas oil at the start of the year. The IEA came out with everything. Yeah, everyone was talking about how EVs are going to displace most of gas oil demand. Gasoline suffered with the same fate.
Yeah.
Everyone was fairly bearish. Trucking demand was expected to go down. Manufacturing demand was expected to hit. We were gearing up for Trump's tariffs. So diesel was meant to have a pretty weak year. But then so the main drivers that we saw, the textbook drivers, you would say, have been the start of the 12-day war. That's when this remarkable spike happened in mid-June. And then later on, the US sanctions on Lukoil and Rosneft.
Of course, yeah. So starting with the 12-day war then, again, just put my mind back to that. I remember we were kind of talking about it when we were doing the Flux News show, right? That it felt more of a short covering rally than anything else.
Definitely. We did see net long positioning also increase. So I'm going to go back and talk about the tightness that we saw in the first half of the year. But even if we just concentrate on the 12-day war, that's when we saw net positioning. This is net money managed positioning. So this includes funds, speculative players. That increased above the 5-year average for ICE gas oil during the 12-day war. But even before then, we had started seeing positioning increase above zero around May, because that's when people were starting to speculate that this might be a tighter year than usual.
Well, the stocks were very low in the US. I remember thinking that's being ignored, and even by ourselves, we have to admit, right? We were just looking at the stocks, but whatever, the macroeconomic scenario is so poor, it doesn't matter that stocks are low. But clearly it was a big deal, because as soon as there was some kind of fundamental reasoning to be strong, as you said, people didn't just short cover, they started to really believe in a distillate rally, and that took over for the rest of the year, I guess. You're looking at the storage stats.
Yes, so this is the days cover for distillate fuel oil. So that is stocks divided by days, divided by product supply, which is a proxy for demand. So just to see what is the storage cover for, do we have enough supply for the implied demand in the US? So this is the red line being 2025. That's been fairly low compared to seasonal levels.
Yeah,
this
it's 2022 levels, right?
Yep, exactly. Especially at the start of Jan, over here at the start of Jan, and then, as we said, mid-June, which is also when volatility spiked during the 12-day war.
Yeah, but again, I remember in the 12-day war, it was very much, distillates is going to rally because people are short covering, and it's a war trade. War trades, of course, you buy the outright prices in oil like Brent, WTI, but distillates is a favorite for traders as well. And of course, you only had to go back to 2022 to see that distillates was the one that outperformed on the back of Russia and that kind of thing. So yeah, it was logical for people to buy into that, but it was also seen as a fade as well. So if you go back to the chart, just for the year. No, sorry, for the just the gas oil crack chart.
Yep. Let's go back to this one.
Yeah, so again, probably can explain the immediate dip back, because this was sorry, I'm looking at the wrong thing. This was the war going on, right?
That's the war.
And then we kind of bounced back. And then, during the fade, there's a lot of people concentrating on the distillate crack, and it was, I guess it was quite a decent trade. But it was around the bottom of it that you were starting to see more and more traders think, well, actually, why is it such a bearish trade? And look what we've just been through. It's not just short covering. Then there's the talk in the market started to be about stocks. Then we heard that trade houses, one particular trade house has stopped out. And I just remember it completely shifting. And I remember feeling kind of stupid, being like, well, the stocks where they are and this whole layup, actually, maybe it is kind of bullish. And the other main thing was versus gasoline, right? That was a huge stop out.
So we saw that in the M1 ARBO versus heating oil.
Right.
So this was around the stop out that you're mentioning.
Yeah.
So we saw prices go down from around, they went to a low of below -40 from above -30 at the start of that month.
Yeah. So again, you're buying, particularly, I remember for actually the summer was the one that was looked at. Summer gasoline versus heating oil.
Yes.
It's very rare for gasoline not to be stronger than diesel. And it was pricing that way, right? Diesel was stronger, and it actually survived the summer that way. And that's when we started to get more and more confident in the whole market, talking about how strong distillate was, because that's such an unusual event for ARBO versus heating oil to be so low, and sustainably so. So that's another big one. So there was a big stop out. Sorry, which way? People were long it.
People were long.
So they had to sell that. Then people piled back in. I know that there was funds that tried to trade the stop out, and that's a popular thing for hedge funds to do and speculative traders. you see a big stop out and, the damage is done. So you take the other side because you assume it's been shocked to its extremes and it's a good risk reward trade. And it did kind of bounce back a bit, but then it still went on its way down again. And this is why, as I say, it kind of built up more and more narrative to actually flip people's thinking and sentiment, right?
No, definitely. Ironically called the Widowmaker trade, and it actually made a lot of widows this year.
Yeah.
But no, definitely. I think it's interesting. So this was definitely the point where everyone woke up and was like, okay, something's definitely happening. Stocks are low. There is this rise in volatility. We saw this with the options market as well. This white line being the week of the 13th June, so that was the day the war started, and then the weeks prior. You see that increase, that surge of implied volatility and out of the money call options. This is gas oil futures options. So yeah, definitely. There was this surge. There was this combination of volatility on the financial side, but also this physical tightness that we'd seen.
Yeah.
And a lot of the market was caught unaware of it.
Well, and then we had the Ukraine drones. So that was again getting shrugged off, wasn't it? So people were seeing the drones come in and bombing refiners, and it was a bit of a, oh, well done you, like you're making an impact on the other side of this war. That's great. And for sure, the physical traders at least were signaling, and it seemed to be in all the S&D analysis that it wasn't something to be too concerned about. But it kept happening, right? Kept happening. And sure enough, the narrative changed to, well, actually, there's so much refinery capacity offline from this. This is actually quite significant. And again, distillates would have been the main impact, or is the main impactor of that. So again, it kind of added weight to that bullish
Definitely.
narrative.
Just specifically on the Russia stuff, that's at its peak around like at the end of Q3 into Q4, 20% of Russian capacity was offline. And Russia is a significant exporter of distillates to a lot of Latin American countries, such as Brazil. And we saw US distillate exports to Brazil. So this is from 2022 to 2025. The US used to export a lot more distillates to Brazil until Russia took over. That's why we see this decline in exports over here. And then that significantly took up with June 2025 suddenly seeing its highest level of exports since 2022. And this was another reason why European stocks were suddenly so constrained, because Europe, as we know, is dependent on imports from the US, from the East.
So suddenly Brazil competing with Europe.
Exactly.
And I think there was also, it's priced on heating oil, but the Russian diesel as well being sent to Brazil, that was also under a lot of threat, which kind of doubles this up.
Exactly. So that's why the US had to step up. And then on the eastern side, into Q4 especially, we started seeing tightness in Asia from refineries going into maintenance, from unplanned maintenance, from threats of secondary sanctions from the US, because India and China were importing Russian crude oil. And we started seeing this tightness. Sinochem also came up with, they started prioritizing jet over gas oil. So there was this tightness from the east as well, which took the frontman gas oil east-west up to above -20 briefly, which obviously closes the ARB. And that led to further tightness in the east, from the east. Yeah. And just to circle back to the start of the year, the reason why nobody saw this tightness build up was because of the biodiesel market. So total distillate inventories fell by 17% in the first half of 2025. This was a decline of around 10% based on this was compared to an average decline of around 14 million barrels.
We're showing it here?
Yep. In the 5-year average. So the EIA shows this year on year. So this dark brown bit is distillate fuel oil, which suddenly took over renewable biodiesel and diesel. And this was because of tariffs. So there was reduced supply of renewable diesel and biodiesel due to tariffs on Canadian diesel. There was 10% tariffs on them. Tariffs on Chinese used cooking oil, which was significant. The tariff war that we saw this year was significantly a part of this. But also, renewable diesel and biodiesel consumption decreased by 124,000 barrels per day in the first half of 2025.
But again, is that tariffs or?
So a lot of that could be tariffs. And this decline in renewable diesel was then matched with about 170,000 increase in petroleum diesel. So petroleum diesel had to step up to match for the loss in biodiesel. And this loss in biodiesel, so there's two sides to this. There's domestic and imports. So on the domestic side, US soybean exports hit their highest level in January since 2010. And this was the fourth largest increase in exports on record. So this was because of a rare discount US soybean had to palm oil due to adverse weather conditions. And that led to US soybean going out as much as it did. That definitely had an impact on soybean supply for the rest of first half 2025. And then on the export side, as I said, the tariffs, I'll show you a chart to explain this was biodiesel exports. This is in 2024, and then this is the year after that. This was US imports of biodiesel and renewable diesel in the first half of the year. So you see that significant year-on-year decline, a lot of which was due to tariffs.
Okay, well, I didn't even know about that. So that's another big factor. So I guess looking at it from the trading side then, a very difficult market to trade because of the chopping and changing of the sentiment. But even if you were bullish, as things were changing, capturing it was quite difficult. Can we look at the technical analysis? Because that's...
So looking at the technical analysis, I've been sharing this throughout the year as well. So the pink lines that you see in the background, this is the Fibonacci retracement level from 2022's high of over $60 to April 2023's low. So looking at these high to low levels and looking at important retracement levels from this is a good way for a lot of algos and for other technical traders to see particular support and resistance levels. So these are good to look at, especially because this week we saw resistance at the 50% Fibonacci retracement level. So that was fairly significant.
That was very recently, right?
Yes, this is very recently. We spoke about this in our technical analysis report as well to monitor this level because that could lead to significant resistance alongside the $41 because that has been historical resistance. So these two still apply. We currently have fallen past the 10-day moving average and we're currently testing the 30-day moving average.
Yeah.
Also very significant.
But very difficult, I guess is what I'm saying, for someone to look at the diesel markets and think, I'm going to position because there is so much volatility. We have an outright crack, which, back when I was trading my early years, a $10 crack was reasonable.
Yeah.
So a $30 crack, and then, the range that you're looking at here with all the stop outs, kind of 3 or 4 stop outs, both from RBOB versus heating oil, from the 12-day war, from the sanctions news.
We recently saw stop outs as well. So this significant increase of over $4, that was short.
Well, there was a period here, I remember this very well, wasn't that long ago. This is kind of getting into Q4, people were like, look, this is genuinely a very bullish market. There's 1,000,001 reasons to be bullish, mainly because the Russian refining capacity is being taken offline and they're still going, they're still bombing it. So you had a lot of people very constructive and expecting a blowout, but that we waned a lot and there was a drifting. And when you're drifting, that's people just losing money in general, I would say. And technically, from a technical standpoint, it would make sense that was quite difficult to trade as well. I would have expected stop outs to have occurred around there, but then you finally got this surge. But you got to admit that would have been lucky for bulls because it was really on the sanction announcement, right? Or when things started to heat up there. So then finally you had the performance and the distillate crack that people were expecting. If you had held on, you clearly, of course, have done very well. But again, as you say, stop outs up here.
Yeah.
We actually do have a good idea, we think, that those stop outs were much more led by margin hedging reversals than anything else. But a lot of people buying back margins that had sold them way down.
It's very interesting to see that because ISCOT data for the past 2 weeks has just been Broadmark's de-risking significantly for the past 2 weeks.
So producer merchants, that's refiners are going to be in there.
Yeah.
We saw refiner margin hedging, mid-20s for the gas oil crack happily, and a lot of volume kind of all year. So it gets to this point where you probably think, how far is this going to go?
Yeah.
Getting margin called, it's costing you a lot of money to have the position on from a capital perspective. It's just not worth it. But as is always the case, you stop out and then the news reverses and now it goes all the way back down. But now, as you said, what's the technical layout going forward?
Yes. So just to circle on what you said, I agree. So this is around this increase around this time, we started seeing sellers come back and we saw momentum shift to the negative side as well, reflecting that this was a time when the sellers were trying to regain control. And then, of course, we saw the sanctions on Lukoil and Rosneft, everything rallied again. But then on the technical side, we then saw, if you see this increase in prices was matched by RSI not really changing. The RSI could not keep up with new highs in prices. That is a bearish divergence. And that often reflects declining positive momentum. So that is something we mentioned this in our reports as well. You need to start keeping an eye on this because that signals that we're going to start softening below support levels. And that's exactly what we've done. Now, these are really bearish candles. These are 3 significant bearish candles. If we close bearish on a candle, that would have the chart pattern we'd see over there is called the 3 black rows. It's like a funny way for a candlestick analysts to say, but it essentially shows that the bearish momentum is building in this market. Although I would caveat that, but I don't think I'm definitely short-term bearish here because the momentum indicators are all pointing towards this continued decline. But we still see, like as I showed with the day's cover, we still see some tightness in this market.
The problem is when you're at these levels, there's no real difference fundamentally between a $30 crack and a $40 crack, right?
Yeah.
It's
I do still think we're going to stay above, say, this purple line over here is the structural 100-day moving average. That's a longer
just don't know, right?
average.
What I'm saying is you're right to look at it technically, I think, because there is so much randomness in this now. There's people who've been stopped out. There's probably people who've entered, probably need to stop out if they've tried to chase it. But forgetting all that, it's just really unknown what Trump's going to do. And I think or not necessarily Trump, what everyone's going to do. And you need to remember there's so much oil that can come online. Like the shadow fleet, the oil on water is incredible. Like this is bigger than COVID, right? When we got oversupplied in 2020. What could hit the market if the sanctions are released, which, I said myself, I can't see this being an overnight thing. But the way it's been written and the way it's been portrayed by the US is you sign this and you don't even have to have got it all implemented. Sanctions will be released. So it really could be an overnight thing. And I think I was wrong there. And if it's an overnight thing, I mean, this could capitulate $10, $15 at least. You really can't put a number on it.
That's
You've got
valid,
everyone rushing for the exit door. So I'd be more interested on the CTA side. Have you been tracking that as well?
Yes, so I don't have a chart for that just right now, but I do know what's happening. So the CTAs are still net long,
right?
And we have a positioning index which looks at which normalizes the positioning and looks at it from its tail ends compared to historical levels. And we're currently still at the tail end of positive CTA levels. So, for example, if I just draw it over here, we're currently at this tail end, and we're currently at overbought settings in the CTA. We're still in, so
there's decent reversal there to happen just from
very
CTAs.
decent, especially because you're just looking at open interest levels. We're currently just under 5-year highs.
Well, this is where the technical charts mean a lot in oil as well, right? Because they are behaving on technical, sure, on a flat price basis, not a crack basis. But nonetheless, the more we start to weaken and with the momentum, strong signals getting stronger and more aligned, CTA sell side volume could really come in quite consistently.
No, definitely. I think, again, breaking this level for more than 2 days would trigger some CTA selling. If we entered this level, the historical level, that could be a pretty bearish sign. That is just like a good way for CTAs they have so much room on the downside if they do that.
If you've got the appetite to be in the market, which I don't think you could say that about a lot of people in the industry. I think a lot of people in the industry are just fed up with this year. It's been whipsaw after whipsaw. Every relative value range has meant nothing, and it's just been crazy. But if you are in, and I imagine there's quite a lot of retail flow, there's quite a lot of spec here and there, it's actually a great market to maybe snipe here and there. If you've got the trade houses kind of on the back foot and not wanting to pile in a lot of risk, then the market's kind of free to do what it wants to do. And if it's got strong momentum and you've got quite clean selling from CTAs, it's actually quite a good market for the tourists, if you like. So that's all I'd really add to that. And we are coming into the end of the year. People are de-risking. People don't really want exposure to this, right? They kind of want to just say good night.
We spoke about this on the Insights podcast last week as well. Everyone's fed up of this market. Diesel exports going up. A lot of that had to do with there were so many different layers to this. For example, we discussed the Russian refinery attacks, but there was also the added element of the US dollar declining that further facilitated US exports. So there's so many different ways to look at this market, and I think a lot of that, just being on top of that, is why the market was caught.
Fatigue, right?
Exactly. At the end of the day.
Yeah, the market's always searching for one or two clear narratives, right? And I'm with you on that.
And I think this year just hasn't had that. There was a biodiesel narrative, there was the macro narrative, there was a tariff narrative, there was this regular oil supply and demand. There's just so much happening that at the end of that, at the end of the day, when the market stopped out of this RBOB heating oil, that's when everyone woke up and was like, something is wrong with this year. We need to be more on top of what's happening with gas oil. Something's up here.
Yeah. Well, look, Mita, brilliantly put. I mean, it's a great summary, and I think it's very topical because this is the contract that's still alive, if you know what I mean. I mean, Brent spreads, people have been whipped in and out of flat price. And again, just to echo what we've been saying, I've got the sense very much that the industry's on the sidelines. But distillates, whether you like it or not, there's a lot of risk there for the market still from a physical perspective. You know, refinery margins, this is the bulk of their economics. And as I said, we seen the hedging to and fro. So I don't think the market can ignore it. And so it's definitely one to look for into the rest of the year. And good summary. So thanks. We'll leave it there and see you guys next time.
Happy Thanksgiving, folks, and welcome to today's European Market on Close episode. So we hope you're enjoying your afternoon or your early afternoon in the US. But here in the North Sea, actually, despite not having the same variety as yesterday, we had a lot of activity. So let's dive quickly and see what happened in Midland today. It was a really interesting one. Obviously, TOTSA wasn't actively bidding as yesterday. So we have their two bids at 170. As we can see here, they're significantly lower than those bids we saw yesterday at 210. But the interesting bit was obviously TOTSA lifted BP's offer, but BP then after that switched to the buy side. So we've seen this flip-flopping recently from BP. The same happens in the Dubai window, and now they've repeated that in the North Sea. So what is going on there? We're quite unsure, but they do some interesting plays recently over the last few days of the month. But if we were to look at our physical differential, so let's do a recap. Yesterday, our physical differential was assessed at 71.5 cents. And today we're looking at slightly stronger compared to yesterday, around 77.5 cents, 78 cents, according to the preliminary calculations by our officials team on the background. So that's everything in the North Sea right now. If we were to have a quick look in the market, obviously this Thanksgiving wasn't as good as Trump promised, because he actually promised about an initial deadline regarding the Russia-Ukraine war, which hasn't yet materialized. So what's happening in the market? We're actually trading slightly firmer, as we can see here on the chart, at the low 63s. But if we were to look at the bigger picture, actually, we've traded pretty much sideways. We've heard from traders that there's not really much activity going on in the market, especially in the November trading of the last few days. So market's rather quiet. They're waiting currently for any concrete action from the US side. Obviously, Russia-Ukraine, whether any peace deal negotiations are going to materialize. But so far, Russia and Ukraine are still attacking each other. So it looks like we still have some progress to do over there. But over the prompt spread has been declining over the recent sessions. As we can see here, we reached a high of 71 cents actually yesterday morning. And since then, we've declined, even going to almost 51, 52 cents, as we can see here on the chart. So that's relatively weaker compared to previous sessions. But remember, backwardation remains. And this is expected as we're heading tomorrow to the last trading session of the month. Obviously, traders are rolling their positions to the next futures contract, so that's expected to see the prompt spread slightly weaken. Now, elsewhere, if we were to have a quick look what's happening in the North Sea complex in general, DFL is a particularly interesting one. Obviously, traders had been bullish at the start of, well, obviously last week and this week, but now we saw a slight softening. We see the DFL, the December one, trading at 81 cents right now, and according to traders, we should expect the North Sea complex to slightly weaken heading from the mid-December onwards, actually. So remember, we had this big adjustment in the physical differential over the last few sessions compared to last Fridays, where we were deeply negative, and that's because TOTSA, Ganvor, and these likes have actually started bidding aggressively alongside all the curves, Midland at 40s mostly. So that's it for today. If you're interested in the officials content, please remember to look at the Flux News podcast, obviously, the LinkedIn, Twitter posts, and obviously our website at flux.live to see the latest posts of the officials. Thank you very much, and see you tomorrow at the Singapore Market on Close. Happy Thanksgiving, folks, and welcome to today's European Market on Close episode. So we hope you're enjoying your afternoon or your early afternoon in the US. But here in the North Sea, actually, despite not having the same variety as yesterday, we had a lot of activity. So let's dive quickly and see what happened in Midland today. It was a really interesting one. Obviously, TOTSA wasn't as actively bidding as yesterday. So we have their two bids at 170. As we can see here, they're significantly lower than those bids we saw yesterday at 210. But the interesting bit was obviously TOTSA lifted BP's offer, but BP then after that switched to the buy side. So we've seen this flip-flopping recently from BP. The same happens in the Dubai window, and now they've repeated that in the North Sea. So what is going on there? We're quite unsure, but they do some interesting plays recently over the last few days of the month. But if we were to look at our physical differential, so let's do a recap. Yesterday, our physical differential was assessed at 71.5 cents. And today we're looking at slightly stronger compared to yesterday, around 77.5 cents, 78 cents, according to the preliminary calculations by our official team on the background. So that's everything in the North Sea right now. If we were to have a quick look in the market, obviously this Thanksgiving wasn't as good as Trump promised, because he actually promised about an initial deadline regarding the Russia-Ukraine war, which hasn't yet materialized. So what's happening in the market? We're actually trading slightly firmer, as we can see here on the chart, at the low 63s. But if we were to look at the bigger picture, actually, we've traded pretty much sideways. We've heard from traders that there's not really much activity going on in the market, especially in the November trading of the last few days. So market's rather quiet. They're waiting currently for any concrete action from the US side. Obviously, Russia-Ukraine, whether any peace deal negotiations are going to materialize. But so far, Russia and Ukraine are still attacking each other. So it looks like we still have some progress to do over there. But over the prompt spread has been declining over the recent sessions. As we can see here, we reached a high of 71 cents actually yesterday morning. And since then we've declined, even going to almost 51, 52 cents, as we can see here on the chart. So that's relatively weaker compared to previous sessions. But remember, backwardation remains. And this is expected as we're heading tomorrow to the last trading session of the month. Obviously, traders are rolling their positions to the next futures contract, so that's expected to see the prompt spread slightly weaken. Now, elsewhere, if we were to have a quick look what's happening in the North Sea complex in general, DFL is a particularly interesting one. Obviously, traders had been bullish at the start of, well, obviously last week and this week, but now we saw a slight softening. We see the DFL, the December one, trading at 81 cents right now, and according to traders, we should expect the North Sea complex to slightly weaken heading from the mid-December onwards, actually. So remember, we had this big adjustment in the physical differential over the last few sessions compared to last Fridays, where we were deeply negative, and that's because TOTSA, Ganvor, and these likes have actually started bidding aggressively alongside all the curves, Midland at 40s mostly. So that's it for today. If you're interested in the officials content, please remember to look at the Flux News podcast, obviously, the LinkedIn, Twitter posts, and obviously our website at flux.live to see the latest posts of the officials. Thank you very much, and see you tomorrow at the Singapore Market on Close.
Bye.